It can be the case that it's appropriate sometimes to look through inflation if it's transitory, and that can be the case in the case of tariff inflation.
Everyone's relieved that the Fed didn't jump to significant conclusions.
If we get to that May 7th meeting and they do not find a reason to cut rates, they're not going to find a reason to cut rates this year.
I don't think there's any chance that they cut in May.
The question is how much of a growth deterioration needs to occur before the Fed can react, and it seems to be that the bar is pretty high for that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday with equities struggling to build on yesterday's bounce as Fed Chair Jay Powell downplays inflation risk.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation.
So Team Transitory is getting the band back together, preparing to look through any potential bump in inflation, and the president wants them to go even further, writing the Fed would be much better, cutting interest rates as tariffs start to ease their way into the economy. The president calling April 2nd Liberation Day.
At a time when they're hoping to get long-term rates lower, Kevin Hassett also speaking yesterday after the Fed decision said that Fed officials are, quote, a little tighter than they want to be, than they would want to be at equilibrium right now. They've backed away. Let's be very clear. This isn't a Fed that's necessarily under that much political pressure at a time where they're using the T word to talk about tariffs and the potential ramifications for inflation.
There is a bullish interpretation. There is a bearish interpretation. We debated this extensively yesterday afternoon. The bullish interpretation goes something like this. Inflation was revised higher, but the median dot didn't go up. The bearish interpretation is that growth was revised lower, but the median dot didn't go down. This market is putting a lot more weight on one versus the other, reinforced by the message from Chairman Powell.
That's right. And what you're seeing right now happen is, I think a lot of people are trying to understand how the Fed views inflation, because they're ciphering off regular inflation that was already there and they were trying to quell, and this quote unquote tariff inflation. And I remembered yesterday thinking about what Scott Bessent, the Treasury Secretary, said to us around this table, thinking of getting the band back together. He said Team Transitory, if they have any credibility at all, they need to look through the one-time price adjustment when it comes to tariffs.
Yesterday's decision, the inflation growth policy mix of the forecast will take on a life of its own at 8:30 Eastern Time. When we get more data, how will this market respond if we get a deterioration in the economic data, specifically jobless claims at 8:30?
Do they get the sense that this Fed will have the markets back and respond to weakness possibly as soon as May if we do get a sign that that unemployment rate is reaching their target of 4.4% more quickly than otherwise expected? I will just say part of the reason why people are dismissing the hawkish interpretation is because Jerome Powell himself came out and said, you know, with respect to the dots, what would you write down? It's really hard to know how this is going to work out. So if they're telling you, we have no clue, we're in a dark room, we're just guessing, but we are looking at transitory inflation and weakening growth, well, that's the reason why people see Dove.
Also, the fact of the matter is, they kind of took a hike off the table. And if you're trying to quell inflation, you would need to hike. This quote, we're at a place where we can cut or we can hold. It's what he didn't say that I thought mattered.
Equities this morning struggling to add to yesterday's bounce. We are slightly lower on the S&P 500, just dipping into negative territory in the last few minutes or so. Coming up on the programme, we'll be catching up with Julian, Emanuel of Evercore as the Fed triggers a rally in equities in the last 24 hours. We'll speak to the former ambassador to Switzerland, Ed McMullen, on President Trump's tariff agenda, and Iain Stealey of JP Morgan Asset Management as Chair Powell brings back the T word. We begin this hour with stocks struggling to add to a post-Fed relief rally. Julian Emanuel of Evercore writing the following. In a Washington where policy uncertainty is swirling, Chair Powell projected a sense of calm and confidence in the eye of the storm. 2025 is a volatile. 3 steps forward, 2 steps back. Julian Emanuel of Evercore joins us now for more. Julian, good to see you.
Good morning.
How many steps forward or back did we take yesterday?
We took a half a step forward. Look, this process, and we think that this is a correction. We are in a bottoming process. The elements that normally tip bull markets into bear markets are not present. The biggest challenge, though, is how policy unfolds, because as we've seen, and Powell pointed out a week and a half ago, the soft data, the confidence, the opinions are all very cautious. The hard data has started to show signs of cracking, but nothing that, as he said yesterday, is significant at this point.
Yeah, I wouldn't say dismiss the soft data, but he certainly downplayed it. and played up where the hard data still was and how decent, healthy the economy still is. The question I would have for you as an investor right now, Julian, is whether the easing bias would be constrained if we got a deterioration in the economic data, whether that easing bias is constrained because they'd be worried in any way, shape or form about higher inflation.
I don't think that's the case. Look, the academic research, and if you go back to the trade wars in 2018 and 2019, let alone going back to the last great tariff era, the 1930s, we'll only mention that once, is that basically inflation was not a concept. Inflation moderated into 2019, and the expectation, and maybe it was an unfortunate choice of words, transitory, but maybe it was intentional to really make a point here. The bigger question is that when you think about it, to your point, John, is that the projections for growth are not consistent with a pro-growth president's agenda over the long term.
That said, you said a half step forward. Is it a half step forward for risk assets if essentially this is a Federal Reserve saying that they're expecting stagflationary-like environment in the near term, which by all accounts has traditionally been terrible for risk assets?
Well, and again, it just goes back to questions of degree, right? So remember, prior to the pandemic, we were thinking that the economic numbers that the Fed is projecting was basically the long run, rate of growth. And in fact, they reinforced that. I suspect they'd prefer to think that the number is closer to 2%. And so from that point of view, it's not necessarily the stag part as much. But again, the whole point here is that the policy disruption we've seen puts the mood such that, you are at that fine line.
You said that maybe it was an unfortunate use of words with transitory. It seemed pretty deliberate. He repeated it several times, and he seemed pretty confident when he said it. He didn't back off from the T word. He embraced that T word. And I wonder at what point we're looking at a revision of what we saw previously, where that word was inaccurately used at a time when you've got a global fiscal impulse that is pressuring yields higher and potentially going to keep inflation at a higher level, just de facto, not only before the pandemic, but more in general, simply because of how many dollars and euros are in the system.
No, and there's no question about it that when you go back to think about the last month, is that the geopolitics of the situation, really caused this fiscal impulse that we see now is going to be the long-run trajectory in Europe. And that's a different set of circumstances and calculations that, if anything, puts a floor under long-term yields, which might be something that the administration wasn't exactly banking on. But again, it comes down to this idea that policy implementation, and this is why, in our mind, how the messaging on April 2nd is so very important, is that you've got to provide, room for the art of the deal to work, not the sledgehammer, the art of the deal, because confidence is fragile now.
Why do you think it's not going to be a sledgehammer, given everything we've already seen from President Trump? You think April 2nd is going to be a blueprint?
I think, again, if you look at it, they say they aren't as focused on markets. That may be true because they did tolerate this drawdown recently, but there's definitely an eye on markets, and there's a knowledge that there's only so much that you can really sort of do in so compressed a time without tipping the confidence into something where the hard data starts to deteriorate.
They've already acknowledged that they're in negotiating mode. Kevin Hassett said that he was recently this week working with Howard Lutnick, the Commerce Secretary, Scott Bessent, the Treasury Secretary, with other countries to potentially negotiate reciprocity before April 2nd. So in that case, you think a Trump put still exists?
So the Trump put, Fed put, these are just terms, quite honestly. The bottom line is whether you're the Fed chair, the president of the United States, or a head of a Fortune 100 company, there's no question about the fact that over the last 30 to 40 years, the link between the equity markets and the economy is inextricable. It's very, very infrequently where there's any kind of divergence. And because prior to the pandemic, there'd been this consistency where the soft data would lead the hard data, the question is, are we returning to that mode? It's not clear, but we don't really want to take that risk.
All right, if we took a half step forward to yesterday, maybe not in resolving all the uncertainty, but maybe following this bottoming out process, are you getting materially more bullish right now after yesterday's Fed meeting?
Well, the concept of materially more bullish when there's as much uncertainty as there is out there has to be guarded. Okay, so what we're doing is we're saying it's time to rebalance your portfolio, add, essentially, if you're doing, portfolio adjustments, this is the dip you want to buy. This is not hand over fist kind of stuff. We've sort of switched out of our low volatility stocks. They've done incredibly, incredibly well. We're adding a little bit more risk. We like the AI theme long term. We think what we've heard the last couple of days is very positive. But this is tempered because this is not an off to the races situation by any means.
Let's finish on this, a phrase we hear a lot of, wait and see. And yesterday we were asking, how long do you need to wait before you see? How much time have we actually got to wait for to see whether this link is still well established between the soft data and the hard data? Because the soft data has clearly deteriorated. And as I said, I don't think that the chairman yesterday dismissed it, but I think he certainly downplayed it. How much time have they got?
Well, isn't that old saying April is the cruelest month only because we have to pay taxes in April? I think April is very, very important. It's very important. And if you think about the fact that the conflict in Europe and the conflict in the Middle East have, if anything, intensified in recent days, it's time to put some wins on the board. April is very important.
Lisa gets hers done in March, just so you know, Julian.
I do.
I know.
Is that actually early? I thought that I was kind of late.
I wish I was a March kind of guy.
Are other people like April 14th?
First week of April.
Really?
Like the day before?
Really?
Every single time.
But that gives me anxiety.
No, March is early. March is good. Good for you. Julian Emanuel of Evercore. Julian, good to see you. Equities, by the way, just erasing some of those gains from early this morning in the European session. Equity futures, as New York wakes up, taking a bit of a dive. We're down now by 0.25% on the S&P 500. We'll keep track of that. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers. Hey, Yahara.
Good morning, John. The Federal Reserve left interest rates unchanged for a second straight meeting, but President Donald Trump seemed to disagree with the move. In a post on Truth Social, he said the Fed would be much better off cutting rates as U.S. tariffs start to transition their way into the economy. The Fed's next meeting is May 7th. Ukraine President Volodymyr Zelensky agreed to stop hitting Russian energy assets as a first step toward a ceasefire with the country following a phone call with President Donald Trump yesterday. According to a statement on the call, Trump also offered to help run Ukraine's electricity and nuclear facilities, saying American ownership would be the best protection. And over to Canada, Canadian Prime Minister Mark Carney is expected to call a snap federal election on Sunday for an expected vote on April 28th. The Globe and Mail reporting the move comes as Canada's Liberal Party takes the lead in some public opinion polls on the back of Carney's rise to PM. That's your Bloomberg Brief. John?
Massive turnaround for that party in the last few months, that's for sure. Yahara, thank you. More from Yahara later on this hour. Up next on the programme, the T word makes a comeback.
I think that Chairman Pyle was clear that if there were a tariff effect, that it's a transitory one, and that's in every economic model. I just think that the tariff effect is probably zero or negative.
That conversation up next with Rob Casey of Signum Global Advisors, live from New York City this morning. Good morning. Equity futures taking a bit of a dive here. We're negative by 1/3 on the S&P, taking a small bite out of yesterday's rally. This came from Stuart Kaiser of Citi. The March Fed pleases markets. It confuses us. Confused others too. This morning, maybe Stuart isn't confused. The Nasdaq is down by 0.5%. The Russell down by 0.5. Under surveillance this morning, the T word makes a comeback.
I think that Chairman Powell was clear that if there were a tariff effect, that it's a transitory one, and that's in every economic model. I just think that the tariff effect is probably zero or negative. We very much respect the independence of the Fed, and there's a massive literature that independent central banks perform better for economies.
So here's the latest this morning. The White House backing Fed Chair Jay Powell's call that the inflationary impact of tariffs could well be transitory. President Donald Trump going one step further, calling for the Fed to cut interest rates. Bloomberg's Tyler Kendall joins us now from the nation's capital for more. Tyler, welcome to the programme. Actually, on this issue, and it's a key issue, the Federal Reserve and the White House seem to be on the same page.
Yeah, John, at this point, looking ahead, saying that this might be short-lived impacts when it comes to the transition that this administration keeps pushing ahead. Important to note that President Trump has long said that he would like to have some sort of influence over those FOMC decisions, previously floating, for example, that he could have some sort of comment period, even as we hear his senior administration advisor saying that they do respect the Fed's independence. But really what's at the crux of the issue here is that Powell did say that we are already starting to see those tariff impacts on the economy and economic projections, and we haven't even gotten the full scope of the White House's plans yet. You mentioned it there, that Truth Social post. President Trump keep pushing us towards that April 2nd date where there are still so many questions about the scope and the implementation. In a bid to try to get more answers, I actually had my own chance to catch up with Kevin Hassett yesterday at the White House, and I asked him about the timeline for those April 2nd tariffs. How long will it take for us to actually see them go into effect? And he told me that the working assumption would be that those April 2nd tariffs would actually go into effect immediately in a bid to reduce uncertainty. Those were his words, as well as to get ahead of importers potentially front-loading goods into the country in between a tariff announcement and implementation. Of course, John, we've heard different things from different administration officials, including that this could be more of a rolling process over a few months. Kevin Hassett did add that expectation he outlined to me was, of course, subject to the constraints of Customs and Border Patrol.
Tyler, he also recently said that he's been working with the Commerce Secretary and the Treasury Secretary with other countries to try to get negotiations done before April 2nd. What countries are they looking at?
Right, well, new reporting that India is apparently coming down when it comes to their own tariffs. But we know, according to our Bloomberg News reporting, that these tariffs could really be subject to how President Trump is viewing the negotiating process when it comes to countries being either cooperative or combative. And that is going to be incredibly important going forward. Just yesterday, President Trump ramping up his attacks again on how Canada has been approaching this process. Importantly, I did have the chance to ask Kevin Hassett also what sort of exemptions or carve-outs there could be. He said again that how the formula is going into effect, we are not expecting any carve-outs come April 2nd, and that when it comes to exemptions, it's really going to be based on how low those countries do end up putting their tariffs. And then, of course, the U.S.'s response would be reciprocal.
Hey, Tyler, appreciate the update. More from Tyler later on in the programme. Tyler Kendall down in Washington, D.C. With us around the table here in New York City, Rob Casey of Signum Global Advisors. Rob, good morning to you.
Morning.
Let's start with the good news and the bad news. The good news is that this Federal Reserve seems to agree with the White House that if we get an inflation bump, it will be short-lived. And you could see that in the forecast beyond 25, into 26, into 27. The bad news, I think, for anyone trying to run the government, you never really want to see the Federal Reserve come out and downgrade growth forecasts and increase the outlook for inflation. What was your response to yesterday?
Well, I think yesterday what we read first and foremost, right, is that there just is this level of uncertainty. And so I think that the Trump administration is getting to April 2nd as quickly as they can, right, because they do want to set out a path for tariffs, essentially to allow markets, to allow the Fed to bake expectations in. The issue with that is the tariffs that they're talking about, reciprocal levels, about, tariff policy, but also non-tariff policy, things like VAT, it's going to be really hard to match those levels on April 2nd. So, great segment from Tyler, and it sounds like Hassett at least expects the tariff implementation to be April 2nd. We don't think so. It's just too quick a turnaround time.
How long do you think for the tariffs actually then to maybe we'll have the blueprint, but to actually be implemented?
Well, I think it'll depend country by country. So I think rolling is probably a good expectation, right? It'll first and foremost depend on the countries that are willing to bring their tariffs down, right? I think those will be potentially the first announcements that we see, right? There's this idea that it's not so much that tariffs will go into effect on April 2nd and then we will have negotiations. It's that the negotiations are happening now, right? And so whatever we hear on April 2nd, honestly, I wouldn't be surprised if the first truth we get on the morning of April 2nd is this is a win, right? Because we're not implementing tariffs on, say, India. later on, I think we will see implementation more so across the board, but in particular on Europe.
So what you're saying is the negotiations are happening now. April 2nd is the day we get certainty, and then a few months later we'll get the enforcement?
Well, I don't know if we're going to get absolute certainty on April 2nd, right? I wouldn't want to be held to that. But I do think we will get a relative certainty as to what countries are going to be tariffed over the course of maybe the month after April 2nd, right? It'll be a question of these are the countries that we are now targeting, and we are working to implement certain levels per country. Do
you think that's going to concern the administration? Because the markets are going to view that as more uncertainty. We're just living in this paralysis.
Well, it hasn't concerned them so far, right? So I would say to expect full 100% clarity and certainty on April 2nd, and to expect that we don't get movement after April 2nd is probably wishful thinking.
There's another sort of fly in the ointment here, which is what actually gets through. There are certain legal challenges that have been ongoing to a lot of what Trump has tried to do. And a number of the celebrations and the victories that President Trump has announced have been walked back or have had a little bit more of a complicated profile. How much of what we're going to see on April 2nd is going to be enactable in the short term, let alone the long term, just within the legal frameworks that there are?
Well, the executive has very wide latitude under IEPA, right, the Emergency Economic Powers Act. So I think for the most part, we could see some court challenges. But, I mean, IEPA essentially gives Trump all the leverage that he needs, all the power that he needs to enact these tariffs country by country. It may not give him the leverage to enact a universal tariff, right? But that's not what we're talking about.
Is there a recognition within the White House that it is important to create some certainty right now, given that everyone around the world is talking about uncertainty, and that word is the new drinking game? Is there a sense that this is actually becoming more of a problem rather than a feature?
Well, I think it's a problem for markets, right? But it's a feature when we're talking about Trump, you know, if foreign policy, international policy, right? Trump is, he uses the idea that he's kind of this crazy man in the White House, I think much to his advantage, right? And it's not to say that his decisions or the announcements that he makes aren't rational, right? I think there certainly is a policy and a strategy behind them. But for countries to not know what his next move is, I think benefits him more than it hurts him.
When you say IEPA, though, that's a national security lever they need to pull. They're talking about, when they talk about messaging on tariffs, reciprocity. You can't use IEPA for reciprocity, or to Lisa's point, it will end up in the courts.
Well, I think it very well could end up in the courts. But the argument the Trump administration has made time and time again, right, is that the U.S. economy is being taken advantage of. It's being taken advantage of by allies. It's being taken advantage of by adversaries. And so I think that there is this sort of link between protecting the U.S. economy, protecting the U.S. worker, and, you know, what we might more traditionally think of as being national security.
I know the spring's about to start. Blue skies. Can we take a more constructive view? What are the chances that the Europeans come out and say, I think we can make a deal here. We'll drop our tariffs on autos for you. Let's level things out. Let's do exactly what you want to do. What are the chances of that actually happening?
Well, I like the sound of that.
I love the sound of that.
And maybe on autos, there is, potentially a bright spot, right? But I think one of the major issues is the intractable concerns between Trump and the Europeans are not things that the Europeans are willing to give on, right? We're talking about CBAM, we're talking about steel and aluminum, Boeing, Airbus, digital services tax is another important one, right? These are things that the Europeans are ideologically committed to, equal and opposite the way Trump is ideologically committed to either removing them or punishing them.
Rob Casey of Signum Global Advisors. We're getting closer and closer to that April 2nd date, and I'm with you both. I think I'm with a lot of you watching this programme as well. Will we actually get any clarity on April 2nd? Because this might take some time. It might take a while.
We might get the rollout on April 2nd, but to Rob's point, the implementation might happen and the enforcement might happen weeks or months down the line. Remember, depending on how they enact these tariffs, IEPA can be day one, but you go 232 or 301, there has to be a public comment period, and that can take a long time.
Something about what Rob just said really struck me, which is it's a feature for this administration to have uncertainty when negotiating with some of the countries around the world. It is a bug for markets. And at what point does some of the uncertainty in markets create something of a bug for the administration in some of the raw data coming out from the domestic sphere? And how do they expedite the timeline where it can be a feature for the international negotiations? It's sort of two separate wheels that are spinning at the same time.
The short answer, not yet. They don't seem to be too deterred by what's happening in financial markets, or for that matter, the economic data. And I'd go as far as saying the chairman agrees with them. Chairman Pyle yesterday in the Federal Reserve pretty much echoed everything we've heard from the administration over the past few weeks.
With one exception. increasing the rate of unemployment, although they did talk about a level of uncertainty, and increasing inflation. And this also is something that they don't want to see, at least not this year.
A one-off bump. We'll see if it's a one-off bump. Equity futures right now in the S&P negative in this session lows. We're down by 0.7%. Up next on the program, Ed McMullen, former US ambassador to Switzerland, on Trump's tariff policy. Equity futures here on the S&P 500 negative by 0.7%. We're taking a bite out of yesterday's gains. Check out the Nasdaq. We're now down by 0.8. Peter Chair of Academy saying this yesterday. This year's dots seem to solidify. We're at 2 cuts max for this year rather than at least 2 cuts. That may weigh on markets in the coming days. That's an interesting way to frame this. If you look at the dots and the distribution of the dots, we have moved from at least 2 cuts to maybe 2 cuts max. And Lisa, that's a shift.
There is a larger question of how much of a signal can we get from the dots. Some people could say that they still have 2 dots priced in, even with potentially higher inflation, is dovish. Other people say the fact that there are only 2 dots and that's the max is that somewhat hawkish. The takeaway is they don't know, but they are projecting higher inflation and lower growth, and that potentially is a problematic mix for risk assets.
We had this debate yesterday, and we could have this debate all morning.
We don't have to.
If you were on the Federal Reserve, we could. We probably should. Maybe for a minute. 60 seconds, 60 seconds.
Carry on.
If you're on the Federal Reserve and you put out those forecasts yesterday, would you have anticipated the equity market being up as much as it was? Because the former Boston Fed president, Eric Rosengren, was out on Twitter, X, just yesterday, and said that members of the committee saw more risk of upside to inflation and more risk of downside to growth. The market may have reacted too much to no change in the rate forecast, but the heightened risks are more consistent with stock market declines. There was some pushback to that bullish interpretation in yesterday's session.
Certainly, it sort of was a surprise to see markets rally the most for a Fed day going back to July. A question, though, from Amanda Lynham. How much was that already priced in? This idea of slightly slower growth, slightly higher inflation. We've already seen Wall Street firms from around the world really come out with that kind of projection. The Fed was saying the transitory aspect, and that probably was the biggest part of that, saying they're going to look through a one-time bump in tariff-related inflation, and that gave people confidence they're going to place more emphasis on downside growth.
Will this market look through it? Check out the bond market, 2-year, 10-year, 30-year. Yesterday, yields dropping at the front end of the curve. That continues, down another 2, 395 at the very front end of the curve. But check out the commodity market. Lots of reasons for copper to be back through 10K. Gold, another all-time high in yesterday's session.
Watch this space. It is the hedge against absolutely everything, whether it's stagflation, whether it's central banks that are trying to diversify away from the dollar, whether it's something of a downturn when it comes to economic growth. And so for all of those reasons, people have been going into gold. At what point does that have to stop rallying for the risk asset rally to really get back up and going?
Gold just a little bit lower today. We're down by 0.7%. On our radar this morning, our top story, the financial markets worldwide. Fed Chair Jay Powell saying the impact of tariffs may well be transitory. President Donald Trump going a step further, calling on the Fed to cut rates with reciprocal tariffs set to take effect on April 2nd.
So what's so interesting about this is exactly what Scott Bessent, the Treasury Secretary, told all of us around this table a month ago. He said, get the band back together. If Team Transitory wants to look at tariffs, that they should look at it as what it is, a one-time price hike. Something interesting, though, Jay Powell said yesterday, was that when you looked at the tariffs in 2019, things like washing machines had tariffs placed on them, but things like dryers didn't. Still, you saw prices elevate. And I think that's what they're concerned about. Whether or not that those individual objects, those individual imports have tariffs on them, the entire supply chain could get a one-time price hike.
That comment by President Trump didn't have a lot of bite behind it. And a lot of people didn't give it a lot of credence that suddenly, will he fire Fed Chair Jay Powell? That seemed to be off the table yesterday because it sounded like Fed Chair Jay Powell was taking very much a page, to your point, from Scott Bessent. It sounds like he had been having lunch with him every week, like they are wont to do. And he listened to what he had to say. He said, okay, let's get Team Transitory back together. The band is here. We believe you. We believe your projections. At a certain point, you have to wonder, are they out of the scrutiny now of the president and now under the hot lights of data that is very complicated? And that has to be the concern for markets.
We get more data later on this morning, 8:30 Eastern time for jobless claims. Let's get you the latest on foreign policy. The Ukrainian President Volodymyr Zelensky backing a ceasefire on energy targets with Russia. The agreement coming after President Trump spoke with leaders of both nations earlier this week. More ceasefire negotiations are expected this weekend over in Saudi Arabia.
So Steve Witkoff said this to us yesterday. He said the technical teams will be going there. Overall, it looks like there is this pathway to peace. When it comes to the technical teams, though, there's going to be a lot of different policies they need to negotiate, security arrangements they need to negotiate. Something I picked up yesterday off this readout. President Trump said he discussed with Zelensky electrical supply and nuclear power plants. And then Zelensky came out and said they're looking at Zaporizhia. This is Europe's biggest, most important nuclear power plant. It is in Ukrainian territory, but it's the Russians, since most of the war, that have had control over it. Potentially, this is where deals can be done. If the U.S. were to come in and say, we're going to be the ones that operate it, in essence, that would be in a security arrangement.
Can we make some progress here? We hope so. We're certainly making some progress on this front. Some more good news for the administration. NVIDIA looking to spend hundreds of billions of dollars on U.S. chip manufacturing. The CEO, Jensen Huang, telling the FT investment will ramp up over the next 4 years in an effort to shift supply chains away from Asia in the face of President Trump's tariffs.
Fascinating, especially because what he said is not only is it tariffs, but it's also a national security issue with respect to Taiwan. This from Jensen Huang. We know that we can manufacture the U.S. We have a sufficient diversified supply chain. If any disaster were to threaten production in Taiwan, he said, it will be uncomfortable, but it should be okay. I just have to go back to this. How much is this a direct response to tariffs? And how much is this just girding for whatever increase in geopolitical tensions there are between China and the U.S. and what that could mean for Taiwan?
NVIDIA's down in the pre-market by close to a third of 1%. Let's talk about those tariffs. Just 13 days to go until President Trump's threatened reciprocal tariffs go into effect on April 2nd, including a 200% levy on European wine, champagne and spirits. Ed McMullen, the former U.S. ambassador to Switzerland, joins us now for more. Ambassador, it's good to see you, sir.
Jonathan, good to see you.
Can we avoid the tariffs on wine, spirits and champagne?
I hope so.
What are the French telling
Tragedy, right?
I've been stockpiling.
You spend a lot of time in Europe, sir. Walk us through what they're saying to you, how they're responding, and maybe draw a distinction between what officials are saying and what business leaders are saying.
Yeah, I think it's very important because the reality is I was on a trade mission, a private trade mission over in Switzerland and Italy. And when you talk to the governments or you hear what the governments are saying, it's very different from what people are saying. Met with over 80 CEOs over the period of 5 days, 6 days. Without fail, every one of them has a long memory and they understand the history of where we are. 2018, 2019, Mr. Emanuel or earlier referred to this. We've been here before. We know where the president's coming from. He's been very clear on reciprocity and demanding reciprocity on tariffs. I think every single CEO who was in those rooms understands the reality. The economy rebounded in ways we've never seen. It was generational success. President Trump did it in 1819. Scott Bessent is an amazing asset for the president on the economy. He adds stability, he adds insight, and I think we're going to see an amazing recovery, just as we did in 18 and 19, and one I think that will be unprecedented.
I imagine you were very popular on that trade mission because I imagine every CEO wanted to know what can we expect on April 2nd. Do you think that it's going to be a sledgehammer when it comes to tariffs or a blueprint?
Yeah, it's a great question. I think, though, we can look at history, and President Trump is very predictable. He makes it clear what he's going to do, and he does it. Lisa just said this earlier. This is a clear message to the world that we're done being taken advantage of. Reciprocity is the key. What I told business leaders is your job is to make sure that your government, not the Brussels bureaucrats, but your government, sovereign nations, make clear where you stand on reciprocity. The Swiss, 99.9% of their products are not tariffed. They are reciprocal. The Italians, similarly, working hard to ensure reciprocity. Malone, fantastic leader. She's dedicated to a relationship with the U.S. on trade like no other. These are two countries that I think are the shining stars of Europe. The rest of Europe that's following the Brussels bureaucrats are the ones who are going to have the problems.
Well, speaking of that, the president spoke to Breitbart yesterday, and this is what he said. The ones that wouldn't be as friendly to us in some cases treat us better than the ones that are supposed to be friendly, like the European Union, which treats us terribly on trade. So what are you saying right now, when we get reports that Kevin Hassett, Scott Bessent, Howard Lutnick are dealing with countries, it is on a bilateral basis, not the European Union as a trading bloc alone?
Well, I can't comment on what they're doing in a bilateral relationship. I can say this. In my experience, we have seen very clearly business wants there to be a bilateral conversation between sovereign nations, because those nations independently have a message to give. The European Union as a whole is truly controlled by a group of bureaucrats in Brussels who have no clue what's going on back home 1,000 miles away in Hungary, in Poland, in Switzerland. This is where the bilateral relationship and the bilateral negotiations, and Jameson Greer, I have to say, is a fantastic guy. I worked closely with him while I was ambassador, does a great job. He worked with Lighthizer. He understands the president's message. We all understand there is a history here, a road path to success. Scott Bessent's laying it out. I think the president's laying it out. And I think we're going to see short-term, the same thing we saw in 1819, short-term challenges, but the terror of tariffs, I think, is more clickbait than it is reality.
When you look at history, though, we did see exemptions, we did see carve-outs. Do you expect that this time around?
I'm not quite sure where we're going with that. I think April 2nd will be a good indication on bilateral reciprocities. I think individual companies are critical. I know in Switzerland, where I was experienced, the average job is $130,000 a year. There are 300,000 of those jobs in the United States. We cannot risk those jobs and those investments. And I can tell you this too. Those 80 CEOs, they know where the growth markets are. They're not in Europe. They want to be in the United States. They want to be investing. So I think they have been given an incentive by President Trump to once again help the recovery in the United States, because as the U.S. goes, so goes Europe, so goes the world. And I think that's the real opportunity for these business leaders, and they know it.
From the business leaders who I speak to, the terror in tariffs isn't just some of the headline risk. It's the lack of understanding what the ultimate goal is.
Yes.
There's this question of bringing back manufacturing to the United States. There's a question about raising revenue to offset some of the tax cuts. And then there's a question of just trying to, create reciprocity and even things out that could potentially even lead to lower tariffs going down the road. It just is confusing when you see some of the relationships with Canada. What did Canada ever do to the United States? And suddenly that's our biggest fight right now at a time where there potentially are bigger fish to fry.
Well, I think the president dealt with Canada and Mexico in the first term. And I think they've recovered from that and they've gone in a different direction, and we're trying to bring them home. That's what President Trump's working on. And frankly, Canada actually on several fronts has got some issues that we have to deal with. The president's working on it. They're an important partner. They're on our border, as is Mexico. And I think the president's clearly shown that he's willing and really focused on making those relationships work. You go through difficult times in any negotiations to get to positive, right? And I think that's where we are right now.
What do you make of the timing of going at Canada at this point, before we have an election? Because I can imagine a scenario where if the Conservatives had won, and they may well still win. That election is at the end of April, reportedly set to take place. That snap election could be triggered by Prime Minister Carney later on today. The Conservatives were in a really strong position with a 20-point lead. Poilievre could have been the next Prime Minister of Canada, still could be. And he would have been a fantastic partner for President Donald Trump. You could have had this North American powerhouse that was going to deregulate everything around energy, low energy cost, accessible energy, etc., etc. And you've seen what's happened. This fight between Canada and the United States has started. Sentiment has shifted in Canada and the support has gone back towards the Liberals. How does that help the cause of the United States?
I had a great conversation with the former ambassador, President Bush's ambassador to Canada. And I can tell you from what I've heard is the real people back in the homeland in Canada, throughout Canada, they understand that the policies of Labour have really hurt them over the years. That's the fundamental reality. That's what we dealt with in this last election. Americans, many of whom have never voted for a Republican, came out and voted for President Trump. I think we will see similarly the same situation with the Conservative government in Canada, based on what I've heard from ambassadors who are there on the ground, who continue to work with Canada. Canadians love Americans. They travel here. They know we're a critical partner. And we go through ups and downs like any family.
Do you think we're risking that relationship?
Not at all. I think the president knows the importance of it. And I think it's time that the Canadians understand the importance of it. The Canadian government. The Canadian people understand it. It's the government, the leftist government in Canada, that has been the problem. It's the reason Canada has suffered the problems they have. And I think reciprocity is the key. That's what trading partners and neighbors do. They have reciprocity if they want free trade.
Ambassador, always appreciate getting time with you.
Jonathan, great to be with you.
To get a better understanding of the world. The former US Ambassador to Switzerland there, Ed McMullen. Canada in focus in a bigger way over the last few weeks.
They're booing us at hockey games. Although Ambassador McMullen is saying that the relationship, like any family, I guess it's like one brother booing another brother.
Do you get booed when you walk into the house?
I'm not a brother, but I have seen some really interesting antics at home. Look, there is this question about sequencing. There's a question about gold. There's a question about just how to go about doing it. I think that what remains to be seen and what I think a lot of people are looking for on April 2nd is what are the metrics needed to strike a deal? And right now, we don't have a sense of that. If that can be achieved, that could create more clarity.
Well, when it comes to Canada and Mexico, also, most people I talk to think this is just the beginning, opening salvo to bring up the negotiations of the issues that the current administration has with USMCA.
Trade very much in focus. Equities, by the way, softer here. We're down by 0.75% on the S&P. Let's get you an update on stories elsewhere with your Bloomberg brief. Here is Yahara Hacker. Say, Yahara.
Hi, John. President Trump is set to sign an executive order this afternoon to dismantle the Department of Education. Sources telling Bloomberg the order will direct Education Secretary Linda McMahon to, quote, return education authority to the states. Elon Musk's social network X has raised close to $1 billion in new equity from investors. Sources telling us here at Bloomberg the company is considering using some of the proceeds to pay down its remaining debt load, and that even Musk himself participated in the deal. And Finland has been named the world's happiest country for the 8th straight year. The U.S. fell to 24th place, its lowest ever level in the global ranking. The study by the Wellbeing Research Center over at the University of Oxford is based on a 3-year average of a population's self-assessment of its quality of life. That's your Bloomberg brief. John?
If you've ever met Alexander Stubb, the leader of Finland, you'd understand that. Always happy. Always in a good mood.
And he seems so healthy. He
right?
Always, just
I think he's a
together.
cyclist.
100%. They're all cyclists. They're all triathletes.
It's those Nordic countries.
Let's move to Finland.
Pretty impressive, isn't it? Up next on the program, Team Transitory gets the band back together.
It's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. I think that would depend on the tariff inflation moving through fairly quickly, and would depend critically as well on inflation expectations being well anchored.
Up next on the program, Iain Stealey of JP Morgan Asset Management, live from New York. You're watching Bloomberg Surveillance. Stocks up 1% yesterday, taking some of that back this morning. Futures lower across the board. On the S&P, negative by 0.6%. On the Nasdaq, we're down by 0.8%. Under surveillance this morning, Team Transitory gets the band back together.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
So here's the latest this morning. Fed Chair Jay Powell downplaying tariff concerns, saying the inflation impact might well be transitory. Iain Stealey of JP Morgan Asset Management writes, we believe the Fed will be able to respond with more aggressive rate cuts if the labour market falters, even with inflation still above target. Iain joins us now for more. Iain, welcome to New York. It's good to see you.
Thanks for having us.
I think you've nailed the most important point for financial markets right now. Are they constrained? Can they respond if the labour market data weakens over the next several months? What gives you the confidence that they can?
I think if you take a step back and think what happened back in 2018, the response was that they waited a little bit, and they probably waited a little bit too long, but ultimately they then reacted. And Jerome Powell was absolutely right. That was a period where inflation was transitory, where it didn't have a huge impact, and actually it was the growth and the labour market that was more critical to them. And I think that will be the case this time. And I look at it from the way, if you think about what they did yesterday, growth forecast revised down both years, inflation forecast revised up 1 year. Next year, they don't actually see much of an impact. So I do think they're going to look through it. And if they start to see really weak payrolls, that's when they're going to react.
I'm with Stuart Kaiser. I found yesterday deeply confusing and deeply contradictory, because on one hand, they were talking about how they're downgrading growth and they're going to look through inflation. On the other hand, Fed Chair Jay Powell seemed to dismiss some of the soft data that indicates weakening, which suggests that they'll be late. How much do you have confidence that they could adjust that stance should some of the soft data start maybe being a little bit more consistent or bleeding into, on the margin, certain hard data points?
I think the way I looked at it was that I saw this as a Fed chair who actually is concerned about the economy. Like reading between the lines, I thought they were concerned about a bit of weakness going on, but they haven't got the evidence yet on the hard data to react to it. And I think what actually is quite clear is they just don't know, and none of us actually know exactly what's going to happen. They're in a really tough spot at the moment. And you think back to 2023, and we had the head fake of the soft data there showing signs of weakness, and it never fed through. So they're probably a bit mindful of that. But ultimately, if you do start to see hard data roll over, and it does typically take a few months, I do think they're going to react. So it's probably going to be more later this year that will be happening.
I understand why the front end of the yield curve rallied. I understand why people started to believe that maybe this Fed would respond to weakness in the economy. Why did that trickle into the long end of the yield curve? Why did people buy the idea that not only is this transitory, but the entire international story that we've been talking about of a relevering in Germany and in China wouldn't suddenly be relevant anymore because the Fed's cutting rates? Why is that sort of the logical conclusion?
But I think he made it pretty clear. They were going to focus on the growth aspect of things. He sort of dismissed all the questions around inflation. And if they were concerned around inflation, maybe that's the back end has to move a little bit higher. But if he's going to look through all of that, and then you've got the asymmetry where he talked about we're either on hold or we're cutting, that probably gives confidence to the bond market.
So this is basically the market believing him. This is the market getting back on team transitory. The market is getting back in the team transitory band. Is that what you're saying?
And I think that's right, because that's what happened in 2018. The last time we did transitory was the pandemic, and yes, that was wrong. But if you think about the pandemic, the difference there is we had positive growth and positive inflation. If you're having an environment of negative growth or a slowing in growth, then the inflation, we should be looking through that, particularly if it's a one hit from tariffs, and particularly if you start to see weakness in the labour market, because that ultimately will bring inflation down.
Powell referred to the tariffs yesterday as being tariff inflation, different from regular inflation. How do you decipher between the two?
I think it's difficult, and I think he actually said it's going to be difficult for us to exactly calculate what is tariff and what is just regular. And the problem, and the slight nuance that we've got relative to 2018, we obviously went into 2018 and inflation was below target. It's not at the moment. So again, that's something they just have to be mindful of over the coming months as they think about what they're going to be doing, because inflation was just at a worse place to start with.
Just to pick up on Lisa's line of questioning, let's sit on the markets a little bit more. Perfectly intuitive. Fed cuts rates, see a rally at the front end, got that, yields drop. That's what happened yesterday. Help me understand what happens to risk if the Fed is cutting because growth is deteriorating but inflation is still above target. How does high yield credit trade in that world?
So, like high yield credit, obviously, it's widened a little bit because of the growth. I think it depends how deeply we think these growth impacts are going to be. And again, that goes back to the problem that we've got, that Jerome Powell's got, is we just don't know. We don't know what's going to happen exactly on April the 2nd. We don't know how long this is all going on for. It's a very difficult argument. I think what we can say, though, is going into this, corporates were in really good position. They're very healthy, fundamentally looked very sound. And I think that's what you have to step back and think about. And yes, if you see a real deterioration in growth, of course we're going to see some widening in credit spreads. But I still think there's this all-in yield argument that we've talked about a lot. People like 7.5%. There's no question about that.
Saw that throughout the end of last year as well, coming into 2025. Let's just finish on this. Economic data later this morning, 8:30 Eastern time, we get US jobless claims. There's a feeling yesterday that the Federal Reserve and Chairman Pyle reduced the importance of the soft data. I wouldn't say dismissed it, but we've said repeatedly through this hour, perhaps downplayed it. How important is the hard data going to be? Do we put additional weight on things like jobless claims? How do we trade on that information?
I think the hard data is really important, and I think actually the jobs market is probably the thing we really need to focus on, because if you do start to see weakness there, it's going to filter through to the rest of the economy. So hard data, jobs market, that's what we really need to be looking at.
More hard data a little bit later this morning. Iain Stealey of JP Morgan. Iain, thank you, sir. Jobless claims, 8:30, Lisa, the one to watch.
If you get some sort of significant uptick, how much do markets really respond to that? And what is the response? Is it the belief now in a Fed put? Is it a belief that bad news is bad news? I am so confused, because I go back to Stuart Kaiser. You look at a stagflationary mix and risk assets rally the most for any Fed day going back to July. Go figure.
He's confused. He's not alone. Up next on the programme, Evan Brown of UBS, Monica Guerra of Morgan Stanley, Mike Pyle of BlackRock, and the former Kansas City Fed President, Thomas Hoenig. All of that and more in the second hour of Bloomberg Surveillance. That's just around the corner.
It can be the case that it's appropriate sometimes to look through inflation if it's transitory, and that can be the case in the case of tariff inflation.
The Fed is in a tough spot. They find themselves in the middle of an escalating trade war.
They'd rather stop short on rate cuts and wait for policy and to see how that plays out through the economy.
This just makes the growth backdrop all the more critical. That really has to hold up for risk assets to validate this move.
All they've told us is we don't know what's going to happen, and essentially, therefore, we are frozen where we are.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, and we start with your scores. Equity futures declining this morning, taking a bite out of yesterday's big post-Fed rally. Equities down by 0.5% on the S&P, and the Nasdaq 100 down by close to 0.75%. We get more economic data a little bit later, 8:30 Eastern time for US jobless claims. The soft data, how dependable is the survey data? How important is the hard data now?
Well, right now we're hearing that University of Michigan is one outlier survey that no longer matters to the Fed, and it never really mattered to the Fed. And so in 2022, when you thought that it did, you were making it up. That's at least from Fed Chair Jay Powell's point of view. Look, if you get initial jobless claims tick up materially, how much does that re-engage the idea of the Fed cutting rates more quickly? That's one aspect of this. And then the other aspect is how much does that support risk assets at a time when you actually have slowing growth, and that could potentially be pernicious to the outlook for the United States?
I thought the T word was retired. I thought we got past that. I thought it was toxic in the halls of the Federal Reserve, but apparently not. It was implied by the forecast. If you open up the SCP, you can see it. A bump to inflation in 25, and then if you look at 26, 27, compare the forecast to where they were in December, exactly the same, no change. For this Federal Reserve, they're prepared to look through it.
They're prepared to look through it. Jay Powell called it yesterday tariff inflation, different from the regular inflation they've been trying to quell, using the same terminology that Scott Bessent, the Treasury Secretary, has been saying when it comes to tariff. They're transitory. Maybe they could have used a different word, brief, fleeting, evanescent, but they're transitory, and that the Fed should be looking through them if they want to have any credibility. This is what the Treasury Secretary said, and this is what Jay Powell said yesterday.
A dovish interpretation of Chairman Powell. Difficult not to have one in the news conference. I wonder how many other people on the committee share that view. If you look at the distribution of dots, if you really, really want to get into this, there's a hawkish skew relative to where we were in December. So when we get the Fed speak over the next couple of weeks, I think it could be very interesting to see how much daylight there is between certain officials and what we heard yesterday from the Federal Reserve.
Yeah, just how cohesive is that team transitory? Is it truly encompassing all of the Fed members, or is it a couple of key members at the very top who are happy to be having lunch with Scott Bessent? Look, I think that there is a real question here. I also think there's a great deal of uncertainty, and we have to keep coming back to this, that when someone asked him about the dots and why they didn't move based on some of the different forecasts, he said, well, what did you write down? I mean, what am I supposed to do? This isn't such an easy time. You come and do this.
I can't stand it when they do that. I've got to be honest with you. There was an arrogant tilt to some of the delivery that I saw yesterday. I have to say, we've got to call balls and strikes. I call it as it is. There was a sense of arrogance there. It's not their job. It's not the journalist's job to put out the forecast. It's the Federal Reserve's. It's why they can go out in several years' time and commission $800,000 for a speech. They have to make a forecast.
Putting aside arrogance, there is this point where they're telling you they don't have a clue. And I think that that is something that becomes very difficult for markets to know what to do with, because as much as we're trying to glean a reaction function, how dependable is it, when ultimately the data could really profoundly change?
Deep breath, I'll settle down. Should have slept more.
Evanescence.
Yeah. She got out the thesaurus, didn't she?
I love this.
I know.
I'm sorry, but transitory evidence, it does, no. An evanescent inflation. No.
Then call it fleeting or brief. We've already went through a transitory environment that many would say, like Mohamed Al-Arian, was a mistake for this.
This hour's going to be special. Equities right now in the S&P, down by 0.5%. Coming up this hour, Evan Brown of UBS Asset Management following a Fed-fueled relief rally. Monica Guerra of Morgan Stanley with President Trump saying the FOMC should cut interest rates, and Mike Pyle of BlackRock on why US recession risks are overblown. We begin this hour with futures negative despite stocks seeing their best Fed day since July. Evan Brown of UBS Asset Management writing, Powell did what he needed to do, which was to keep a low profile and wait for more clarity on Trump's tariff agenda before sending a strong message on rates. Evan joins us now for more. Evan, good morning. Good to see you.
Good to see you, John.
As a fiery open to this hour, forgive us. Your interpretation of yesterday, let's start there.
Yeah, well, I think Lisa nailed it by saying the Fed doesn't have a clue. None of us have a clue. We're waiting for April 2nd in the big tariff news, and it was the Fed's job to just say, okay, with the tariffs already in place, here's how our forecast has adjusted. But other than that, just do as little damage as possible. Don't pre-commit yourself to anything, because we just need to see what's going to come out on April 2nd. And so I think, you see the shift in the dots, you see the shift in the forecast, but really I think Powell gave a good press conference in which he probably used the word uncertainty 1,000 times. And that's the reality.
Because things are very uncertain, so you can't put too much weight on the forecast. But I do think this is an important exercise to learn something about the reaction function. How would they respond to certain scenarios? Do you have a degree of confidence that if we do get a deterioration in the hard data, if it follows the soft data lower, that they're able to respond by cutting interest rates?
Yes, strong conviction that's the case. We're very much of the view that, and I think Powell essentially shared this, that they seem more concerned, or I shouldn't say they, Powell seems more concerned about the downside risk to growth. And that's our view too, is ultimately you get this one-off shock in inflation. That's going to weigh on real incomes. It's going to weigh on business hiring decisions and CapEx decisions. And ultimately, the Fed, once they just start seeing a hint of that hard data weakness, they'll be more inclined to cut. That's what we saw in 2018, 2019. Even though inflation is more elevated, I think that's the bias of the Fed, and I think that's the right one.
Which is the reason why I understand the reaction of Treasuries rallying at the front end. I really don't understand the long end. Basically, the market that previously had concepts of inflation being stickier and possibly even reaccelerating over the long term heard the transitory word, said, you got it, all right, we're in, and we're going to buy Treasuries. At what point is the fact that the Fed is going to cutting rates in the face of weakness potentially increase the risk of longer-term inflation becoming stickier, more entrenched?
It could. It's difficult. I mean, there's a lot of things going on with the long end right now. You've still got concerns about the budget deficit. You still got concerns about what's happening with a rise in rates around the world, particularly in Europe, and so that putting some upward pressure there. So I think you are going to see. We have more conviction that you'll see more of the action at the front end of the curve as the Fed shifts.
So is that what you're talking about when you say Treasuries remain a good hedge for risk assets? That it's really cash-like Treasuries, not necessarily long end.
Closer to the front end, yeah, that's our view.
What do you make of the rise that we've seen in gold? The fact that it hit a record high yesterday after the press conference, at the same time you did get some sort of rally in risk assets.
Yeah, I just think gold is, it's the perfect manifestation of policy uncertainty. I mean, yes, we've got what we all know is the steady accumulation by central banks around the world that are providing some kind of support there. But really, the one hedge for kind of I don't love using the word stagflationary because I think it exaggerates the situation that we're in, but an environment where you have slower growth and where you have stickier inflation, gold has proven to be the most dependable hedge in that scenario. And gold just continuing to rise in this environment reflects still that growing uncertainty and reflecting an uncertain Fed yesterday.
Do you think you'll be less uncertain after 13 days after April 2nd?
That's the thing. We would hope so, but we really don't know. We'll get a lot of announcements, but how much is the administration going to implement tariffs right away versus say, okay, we're going to have this review period and we're going to leave time for negotiation? How much of it is going to be based on these reciprocal tariffs being based on tariffs versus non-tariff barriers? And the reality is, it does not seem like the U.S. Trade Representative is adequately staffed up for the complexity of all of the things that they're going to need to do to actually make reciprocal tariffs work. So my concern is that we go and we have this event and a lot of the tariffs are announced, but we don't know what's actually really on and what's not, and it's going to take time, and that's going to prolong that uncertainty for businesses. Which I think it's another reason why we kind of lean into bonds is I think these headwinds are going to stick with us for a good part of the year.
If we're more uncertain even after April 2nd and there's basically businesses saying they're going to be on pause, then would you view the Fed as really leaning into the fact that they're concerned about growth and less about inflation?
Yeah, I think so. I mean, look, we're talking about soft versus hard data. I do think you're going to need to see some weakening of the hard data beyond what we've seen so far. It's been very modest to get the Fed really moving.
Will they then be behind the curve, though?
They could end up being like a meeting or two late, but I think in the end of the day, if they're a meeting or two late, that means they're doing 50 basis point cuts later this year if things are getting really bad.
Want to congratulate you. You were early on pro-China and talking about the China trade and international trade. I'm just wondering whether you're closing that out, whether you think that that's basically had its run, and now you're starting to pick up the pieces in bonds and gold.
Yeah, so we've had bonds this year. We've had gold for a good part of the last year, and then we've had this international exposure in China and Europe, and that fortunately has worked out well. I think the speed of the move at this point is getting us to say, okay, it's time for a little bit of a break. I mean, you look at European banks, they're trading like a meme stock right now. It's like 35% up year to date.
Can you translate taking a break? What does that mean?
What I would say is, some consolidation. We kind of move sideways a little bit, and would not be surprised at all with with tech and Mag 7, which have taken an absolute beating, if we get a little bit of rotation back into there, over the next few months. But I do think the structural theme is going to be more towards allocators moving, away from the U.S. and just seeing better opportunities. Look at Germany. We've been waiting for this fiscal stimulus to get unleashed for a long, long time.
Decades.
It's finally done. I think that theme has something to run. And so, we expect over the course of the year and coming years, more allocation into international markets. Getting a lot of questions about it from clients. I think U.S. investors have a very, very long home bias, and it's been a wake-up call over the last few weeks. And so, I think you'll see more allocations into international.
I know how that pitch has gone for strategists for the best part of a decade. They say you need to diversify, you need to buy international, and they just go, whatever. I think that's started to change over the last few months.
Yeah, that's what we heard yesterday. And we were talking about how there's nothing better for an advertisement, an educating lesson than saying, look, it's trading like a meme stock. You might want to get in.
Evan Brown. Good to see you, sir, as always. Thanks for being with us. Evan Brown of UBS Asset Management. Plenty of feedback on the Fed decision yesterday. Appreciate all the incoming emails. This from Kit Jukes of SocGen. Central banks are flying in the fog without a radar. That seems to be how you feel this morning.
Well, yeah, and it's really frustrating because it's hard to say anything particularly insightful about flying in the fog with blinders on, and that's essentially what they're telling us. So at this point, how can we understand what the reaction function is? And I'll add to this. Who's going to be at the head of the Federal Reserve by the beginning of next year at a time when potentially they're facing a pretty complicated mix of data?
Is that a question? Because I can't answer it.
Okay, who?
I can try. I can tell you who'd like to be.
Okay.
He's the guy who dissented.
Right. Yes, about the balance sheet. Yeah. So this just raises a question. What is his name rhymes with Solar?
I think we could just say it. Governor Waller's put a bit of daylight between himself and the committee. And Governor Waller's been able to stick his neck out on a few occasions. And we saw that with tariffs, by the way. So he was the first one to come out and say, I don't think this tariff policy issue is going to be inflationary. And then you saw the rest of the committee start to follow, based on the communication we got from Chairman Pyle just yesterday.
Yeah, it just raises another layer of uncertainty. If there isn't going to be continuity at the leadership of the Fed, can we really rely on a reaction function for being longer lasting than, say, the remainder of this year?
And once Bowman got Barr's job, Waller was nominated by President Trump in the first term. That's got to be the favourite right now. It's got to be the favourite right now.
Housewives of Washington.
We'll see. These things can change. Equities at the moment softer. We're down by 0.4% on the S&P with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hekes. Hey, Yahara.
Hi, John. India will be included in President Trump's reciprocal tariff slated to take effect on April 2nd. In an interview with Breitbart, Trump said the country is, quote, one of the highest tariffing nations in the world. To try and avoid tariffs, India had lowered duties on imports of some American-made products and even agreed to buy more energy and weapons from the U.S. Meanwhile, NVIDIA is reportedly planning to invest hundreds of billions of dollars in U.S.-made chips and electronics. The Financial Times reporting NVIDIA will spend about $500 billion in the U.S. over the next 4 years. CEO Jensen Huang telling the FT NVIDIA can manufacture its latest systems in the U.S. through suppliers like TSMC and Foxconn. And copper prices topped $10,000 a ton earlier. They are now a bit lower. The rally comes after President Trump ordered the Commerce Department to investigate U.S. imports of the industrial metal last month as a likely precursor to imposing levies. Since then, U.S. prices have spiked and traders have scrambled to send the metal to America ahead of any tariffs. That's your Bloomberg brief. John?
Hey, Yahara, thank you. Tariffs front and centre. This data point out of Canada just moments ago. Small business optimism in that country collapsing to a 25-year low. Just some of the data points you're seeing in response to the policy changes.
Yeah, Canadians care. They care a lot. And this has become a real issue. And we've heard that from the Bank of Canada themselves, saying that we cannot see exactly how we're going to progress because of uncertainty. And we heard the same thing from the Riksbank and the SNB overnight.
Another data point, if you are just joining us, small business optimism in Canada collapsing to a 25-year low. Up next on the programme, same question, same answer.
President Trump fired 2 members of the Federal Trade Commission. If those firings stand, is that a threat to the Fed's independence?
So I think I did answer that question in this very room some time ago.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Nope. Monica Guerra of Morgan Stanley joins us next. Live from New York City this morning. Good morning. It's a softer session today. Equities down in Europe on the DAX were lower by 1.4%. No positive follow-through over in the United States either. Here stateside, equities softer. We're down by 0.4%. On the Nasdaq 100, we're down by 0.5%. Under surveillance this morning, same question, same answer.
If those firings stand, is that a threat to the Fed's independence?
So I think I did answer that question in this very room some time ago, and I no desire to change that answer and have nothing new for you on that today.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
You've got to always have a follow-up question ready for these guys, just in case they go short. It's like a nightmare for any journalist. Like, no, oh no, what do I ask now?
I actually feel for her, and frankly, they're like, I could completely.
Can you expand upon the no?
Yeah,
no.
He played that game yesterday in the news conference too, a few times, with various questions. Fed Chair Jay Powell reiterating he's not concerned about President Trump's threats to Fed independence. Trump pressing the Fed to cut interest rates later on in a post on Truth Social last night, to cut interest rates and embrace Liberation Day on April 2nd. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, we talked about this briefly. Just how much daylight is there between the Federal Reserve and the White House?
Well, John, at this point, it appears that they are on the same page when it comes to there being a potential short-term inflation bump due to tariffs. And Jerome Powell saying yesterday that he does believe that those long-term inflation expectations are well anchored. However, when it comes to the growth forecast, it does appear that this White House is taking some issue with that. Kevin Hassett yesterday telling reporters that his forecast is 2.5% GDP growth for this year, of course, differing with what we saw from those FOMC projections. Now, just to go back to the bite that you played at the top there, we should note that while President Trump has previously criticized Jerome Powell, particularly back in November, heavy criticism about how the Fed was cutting rates close to the election, he has said that he does intend to let Powell serve out his term. And we have heard from this White House that they do respect the Fed's independence. Going back to Kevin Hassett yesterday, who, by the way, last month did reveal that he was having regular meetings with Jerome Powell. He says that at this point he has no intention to cherry pick the Fed chair's statements.
Hey, Tyler, appreciate the update. As always, Tyler Kendall there in Washington, D.C. with us around the table to extend the conversation. Monica Guerra of Morgan Stanley. Monica, good morning to you. Let's go to the president's post on social media yesterday. Liberation Day is April 2nd. How are you describing April 2nd for clients? What's going to change? What's going to remain the same?
I think it's going to be, a will you or won't you moment. We're essentially have to take the lead from Lutnick. And what he's made clear is that all of these reciprocal tariffs, could either go into effect or not. And that's sort of the big driver, right, of all this policy uncertainty. And so we're trying to sort through that with our clients and essentially keep them really focused right on those long-term, investing goals, et cetera, but also try to look through potential tariff risk and highlight different industries and sectors that could be insulated from potential changes.
So what industries, sectors, and countries specifically are you focused on?
We're looking obviously at China. How far can they go with China, I think, is the question right now. People forget that under the Biden administration that he kept ratcheting up tariffs with China. And so, yes, These are new tariffs with Trump, but it is an extension of that 2018 policy. So how far can you go there? Look to see what's happening with India. Obviously, Mexico and Canada, we think that there's less of a risk for long-term tariff ramifications there just because of how closely our supply chains are integrated. But when you're thinking about industries that are insulated, it's utilities, real estate, financials in some cases. And so for us, those are the areas that we're looking at. And some of those areas are actually also beneficiaries of potential deregulatory policy. So once we actually move past downsizing, cuts, tariffs, all of this, austerity, I think the narrative will eventually change.
You mentioned India, and the president mentioned India yesterday in this interview with Breitbart, and he said they're going to probably be lowering those tariffs substantially. On April 2nd, we'll be charging them the same tariffs they charge us. Do you see this period right now as the negotiation? Because Kevin Hassett said he's working with Commerce Secretary Lutnick, Treasury Secretary Bessent, now with countries to try to see if reciprocity could be reached.
Yeah, and that's what essentially that's what they're doing over this period. They gave us that April 2nd deadline, and we'll have more news, right? More shall be revealed on that day. The thing for me when I'm thinking about fiscal policy and budget, what people forget is that they're planning to use tariffs as a big offset. And I've talked about that on here before, but what that means is that there is going to have to be some certainty before they get a budget across the line. So when I'm talking to clients and thinking about market volatility as it relates to policy uncertainty, we do think that that'll likely continue through the summer, but that August through that October period where they have to get things locked up, they're going to have to make hard decisions and account for where the tariffs are actually going to be levied. And so we'll have more certainty then.
This is something that Tom Becker of BlackRock raised, this idea that people think that the U.S. is practicing fiscal restraint right now, but that's not actually what's going to happen. And later this year, you could actually see fiscal expansion, and we're just seeing the offsets to what that could look like later on. Do you agree with that? Are we going to actually still see fiscal expansion in the United States at the same time that we get fiscal expansion in Germany and fiscal expansion in China? Everyone's exceptional in a new fiscal expansionary world.
I think that you get fiscal expansion in 2026. So if you're thinking about legislation and what can get done this year, it's all about that budget bill. So it is going to be a restrictive policy. Now, at the same time, where you get growth is from that deregulation activity that's happening in the background. So those two things are going to offset each other, but it doesn't necessarily mean the same type of fiscal, expansion, the fiscal tailwinds that we've seen. 2026 is when I think, I keep saying, they're going to turn the spigot back on, because what is the job of Congress? It's to manage interstate commerce, look at the tax code, and spend. And so that is what they're going to go back to, right, is what they do best, right? And that's what they do under any administration. And so this is a point in time moment, and then we're going to go back to business as usual.
Based on the debt pile, what they do best is spend and spend a lot. And then a whole lot more. Monica Guerra of Morgan Stanley. Monica, it's good to see you, as always. Surprise coming into 2025 wasn't US policy. It was how everyone else was planning to respond to it. We started to see that from Europe. I think we've got to ask more questions about how Canada is going to respond to this as well. So the Globe and Mail reporting today that the Prime Minister Mark Carney is set to call a snap federal election on Sunday for an expected vote on April 28th. We'll see if we get a final decision from the Prime Minister later on over the next several days. But it's interesting to see how the data is already turning in places like Canada. I mentioned this briefly if you are just joining us. Small business confidence dropping to a 25-year low in that country, pushing potentially Canada to respond as well.
Especially at a time when you're talking about 25% tariffs and you're talking about severing a relationship that has been like a family at a certain time that you don't have a sense of what's going to potentially replace it. You can understand it. So you get a fiscal bazooka there too. Everyone's doing it. Why not?
Not everyone can do what Germany's trying to do. Not everyone has the fiscal space.
Can everyone do it at the same time as well?
With great difficulty potentially for this bond market. Mike Pyle of BlackRock on why recession fears are overblown joins us next. From New York, this is Bloomberg. Nice rally yesterday. We take some of it back this morning. Equity futures negative by 0.5% on the S&P. On the Nasdaq 100, lower by about 0.2% on the S&P 500. 2 hours until the opening bell. Let's get you some morning movers. Here's Yahara Hacker. Say Yahara.
Hi, John. We start with Stellantis falling 3.7% here in the pre-market. This is after its chairman said tariffs are a risk to its future car production plans in Italy, even as the company makes big investments there. But also weighing on this stock is a downgrade by the team over at Piper Sandler. The analyst is warning that all automakers except for Tesla should be avoided. Next up, we have Five Below shares. Those are soaring here in the pre-market, up nearly 10% after the discount retailer issued a better than expected outlook. It's interesting to see it rising so much because the company did say it expects tariffs to weigh on margins. That's because 60% of its products come from China, but they say they are trying to mitigate this by raising prices, but of course, keeping them below $5. And last up, we have Darden Restaurants. Those shares are falling slightly, about 0.6% after the company behind Olive Garden just reported results. Third quarter sales missed estimates, and looking ahead, it maintained its guidance. Of course, it'll be interesting to hear what executives have to say on the call about the consumer, since we did see restaurant spending fall in the latest retail sales report. John?
It was a soft part of the report, that's for sure. Yahara, thank you. More from Yahara later on this morning. On our radar this morning, President Trump saying the Federal Reserve should cut interest rates as he prepares for a fresh wave of tariffs, posting on Truth Social, quote, the Fed would be much better off cutting rates as U.S. tariffs start to transition their way into the economy.
You know, normally, I remember a couple months ago, if President Trump had messaged this before he was inaugurated, people would have gotten very concerned and said, oh my gosh, he's questioning the independence of the Federal Reserve. It seems like there's been a bit of a coming together, frankly, of Fed Chair Jay Powell and certainly Treasury Secretary Scott Bessent. And a lot of what Fed Chair Powell said yesterday can't be that offensive to what the White House is saying. So even though he put this out there, I don't feel a lot of outrage on Wall Street, you know, saying, oh my God, this is going to
because you're desensitized.
Exactly.
You think so?
It was only a matter of time. He said that he thinks he knows, has a better feel of where rates should go. He's a real estate guy than even the Fed. He's like, I know I can't dictate the policy, but I certainly have an opinion, and I'm going to share it. And that's what he did. He shared his opinion. I would say if the president's watching this morning, maybe the Fed could cut rates when he has more certainty on where policy is going. And for that, we need to wait 13 days for what he is calling, quote, Liberation Day in America.
I am desensitized. Isn't that the point?
Everyone is.
That's kind of the point of this whole thing, no?
We've heard it so many times that it just doesn't carry the same weight that it used to. People used to freak out about this in the first term, and now it's just like, yeah, here we go again.
People used to freak out a lot about a lot of things, and now people are just sort of like,
I was more surprised about how late it came. Like, I woke up to that, and I went to bed thinking, weird, we didn't hear from the president.
You were expecting a
about the
live blog in the news conference. I think we all were. Equity futures right now just a little bit softer. More on the Fed in just a moment. I want to get an update on foreign policy. President Trump telling Iran's supreme leader he has 2 months to reach a new nuclear accord. Sources telling us here at Bloomberg, Trump laid out the deadline in a recently delivered letter as he increases pressure on Tehran.
This is a story I had yesterday, this letter that went via the UAE to Tehran. Trump is saying you have 2 months. This is a carrot and stick approach. There's an overture saying maybe we can make a deal. At the same time, we see maximum pressure coming back on Iran, potentially even more sanctions, but also we see what's going on with the Houthis. Basically, the message to Iran is stop with not just nuclear, but also the money that you are funding to proxies like Lebanese Hezbollah, Hamas, and the Houthis.
That's the latest on foreign policy. Elsewhere, the White House is considering extending Chevron's license to pump oil in Venezuela, reversing a recent push to have the company wind down operations. The Wall Street Journal reporting the U.S. will still impose penalties on other countries doing business there. Mike Worth of Chevron was in the building, in the studio with us a number of weeks ago. We talked to him about this. This was always going to be on the radar of this administration.
It sounds like he's been spending a lot of time in Washington, D.C., lobbying them to explain that if Chevron gets out, guess who gets in? China. Guess who end up buying some of this oil? And it creates this real pressure. If you do want to create some sort of isolation and to have a geopolitical negotiating tool, how do you do it in a way that doesn't advantage some of your potential opponents in other potential strategic ways? And this has been something that has been an ongoing challenge.
That's the latest reporting from the Journal. Let's turn back to the markets. Stocks just had their best Fed day since July after Fed Chair Jay Powell says tariffs' impact on inflation might be transitory. Mike Pyle of BlackRock writing, while negative stock-bond correlation has re-emerged, we do not believe it will persist. With sticky inflation, tariffs and significant U.S. fiscal deficits, the Fed faces challenges and term premium will come under pressure. Mike joins us now. He's also the former economic advisor to President Joe Biden. It's good to see you, Mike, as
good
always.
To see you.
Should we start there? How does it feel? Does it feel good? Have you shaken the Washington, D.C. off? Do you feel better about it?
I've got a spring in my step. Happy to be back in New York and happy to be with you.
We can get into the markets in just a moment. I'd love your assessment of where the economy is and how these policy changes might influence where the economy goes in the coming quarters.
Yeah, I mean, certainly I think we're in the midst of a pretty significant set of shocks. So obviously, trade policy uncertainty, both the magnitude of it and the uncertainty around it. Certainly, I think some slowdowns more broadly in the data. The flip side is, the United States is a very dynamic, very resilient economy. And I think what you heard from the Fed yesterday is, while these shocks are significant, while growth is likely to come down, while inflation in the short term is likely to move higher, still there's a kind of underlying strength there that's going to see growth through.
When it comes to tariffs, all the players. Obviously, we're not in the Trump administration, but who they're dealing with on the other side. Do you think we get to a place where it's methodical reciprocity?
So I think what we've seen from other countries is, a likelihood that, this negotiation is going to play out in the backdrop of not just tariff announcements from the United States, but threats of retaliation from others. And I think that, I think one of the big questions as we roll the clock forward over the next 3, 4, 5, 6 months is, not just where do U.S. tariff levels end up, but where do other countries end up with their tariff levels? To the extent that, deals are possible, negotiations can reach some kind of resolution that ends up with tariffs perhaps lower than what gets announced on April 2nd on both sides. I think that's going to be ultimately a world that's healthier for growth and inflation globally. I also think at a minimum, as we roll the clock forward, we're going to get more certainty, and that's going to take some of that uncertainty discount off of economic forecasts as well as markets.
But if there's this reciprocal tariffs and then there's the hit back, the tit for tat, do you think there's a chance you can tip the United States into a recession? Powell said it's moved up, but it's off the table for now.
Yeah, like I said, I would just echo, Chair Powell. The shocks that we've seen are significant. We're going to see significant shocks. That's going to lower growth. That's going to mean, at least in the short term, higher inflation. But that the underlying momentum, the underlying dynamism, the underlying strength of the U.S. economy is, quite significant, and that's hard to turn around.
You might agree with the Fed on that front. I get the sense you're not exactly joining the band yet of transitory. You're kind of on the sidelines saying, I'm not sure that that's actually the case. And you made a point about you're not totally buying the long end rally that we're seeing in treasuries. Can you talk a little bit about what you're seeing that makes you disagree with the Fed's assessment that we can resurrect this word transitory?
Yeah, so I think that, that when you look at the long end of the U.S. curve, yes, we've seen a rally over the past couple of weeks as these growth scares have worked their way into the market. But looking out over the medium term, inflation does look somewhat stickier. And obviously, we're going to have a shock on that in the short term. I think fiscal deficits are likely to be persistently high. And, when you face a backdrop like that, I think you do see pressure on term premium built up, particularly from the starting point we're at today. And that means that bonds are going to be less strong as diversifiers kind of rolling ahead as they have been the last 2 or 3 weeks and as they were, during the 2010s. That means that investors are going to have to seek diversification in other places, whether that's managing fixed income in different ways or seeking uncorrelated sources of return that can provide that diversification.
Where do they find those uncorrelated sources of return? And I'm so pleased you've brought up this topic because I've lost count of how many times we've asked this question over the last few weeks or so, haven't we? We've gone back and forth on this. Are we seeing a reduction in risk mitigation characteristics of treasuries? Over the last few weeks, I think slowly you've started to see some evidence of that.
Gold. I keep thinking gold. Are you just going to gold? And is that the reason why you see it keeping on rallying?
Yeah, I think that exactly to your point, John. Obviously at the beginning stages of the pullback, you saw really strong reactions from the Treasury market. That's diminished as we've gotten kind of deeper into this period of volatility. I think that's a harbinger of what's to come. At BlackRock, one of the things that we would say is you should, seek diversification from things like stable long-term cash flows that are less growth sensitive, that are more inflation sensitive, places like infrastructure. The thing that we really look at are things like, our quantitative multi-strategy hedge fund, built on the back of 40 years of innovation and leadership. They've come through this period generating solid alpha. And what it proves out is, having a range of different strategies, a range of different ways of generating alpha. And in this environment in particular, what's worked is, strategies that are primed in market reversal periods, strategies that provide liquidity to segments of the market across asset classes that can generate alpha even in the face of market dislocation. And that's what investors are looking for.
John, that's not nearly as sexy as gold. Multi-asset, diversification, steady cash flows.
But, they've got things to sell here, Lisa. Not just gold bars.
I know, exactly.
Private markets, infrastructure funds, all of those kind of things. I'm not throwing shade. Total respect for the position. The answer used to be bonds, used to be German bonds. And obviously that's not the answer anymore. How have things changed in Europe from your perspective?
Yeah, so I think it's actually a really interesting moment in Europe. I think the debate within the firm is this a trade or is this a more durable investment? On one hand, obviously, Europe, Germany has stepped forward with a set of fiscal policy changes that, as far back as when I was in the Obama administration, we were calling for. That is really tremendous to see. But I think that among the bellwethers that we're looking for is this going to be coupled by changes in the regulatory environment? The Draghi report talked a lot about the degree to which Europe remains uncompetitive in the technology sector, the types of spaces that really drive innovation and growth. If we see a turning of the page there, that might be, a precursor for a much more durable European trade over the long term and take it from just a 3-month, 6-month trade to something much more long lasting.
I'm sitting here smiling. I've known you a while. It's nice to hear you talk about markets again. It's been too long. It's nice to have you back in this seat. I want to finish where we started. How are we going to make sure that talented individuals keep going down to Washington, D.C. to do the kind of work that you did, that Dalip Singh did, that Wally Adeyemo did? How are we going to make sure that continues?
So, I think when I look across, a number of friends that I've had who've served not just in, Democratic administrations, but Republican ones. I think to folks like, Justin Muzinich, who was the number 2 at the Treasury Department in the first Trump administration. I look into this one and see, really thoughtful, qualified people as well in important pockets of that administration. I think that the call to service is a strong one and the call to deliver for the country is a strong one. And I expect that we're going to continue to see that across administrations of both parties.
I hope that remains the case. Mike, it's good to see you. Mike Pyle there of BlackRock. We've talked about this before. Really talented individuals that we see on both sides of the aisle. In this administration with President Trump, we spoke to Secretary Bessent about that, in the previous administration as well. That's what you want to see. You want to see the best of America still going down to Washington, D.C., and I hope that remains the same.
I'm smiling because that sounded like you're running. No, I'm kidding. I'm not going to do that to you. I'm just thinking to myself, though, that is what I've heard from a lot of people, that the call to service is one that you answer. And you do just hope that continues through the years, especially through the turmoil.
Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Hamas says talks with mediators to halt Israel's ground incursion in the Gaza Strip are ongoing. The operation is seen as a response to Hamas's refusal to release the 59 remaining hostages. This comes as Israeli Prime Minister Benjamin Netanyahu says a larger front of the war could open up in the West Bank. Meanwhile, the Ontario Teachers Pension Plan is shutting down its Hong Kong office. Sources telling Bloomberg it's trying to reduce its China exposure amid rising geopolitical tensions. In a statement, the fund said its Hong Kong office will be wound down over the coming 18 months without giving a specific reason. And California Governor Gavin Newsom has been mailing cell phones to CEOs of the top 100 California-based companies with his phone number programmed into the contacts. Newsom's office said he's been doing this since November in an effort to connect more directly with business leaders in the state. That's one way to do it. That's Bloomberg Brief. John?
Yahara, is that story for real? That is absolutely unbelievable. More from Yahara a little bit later. Did you hear that?
Yeah, I don't know why you would need to send CEOs
a
cell
phone
phones.
with your cell phone number in already.
But you're the governor, so everyone should be taking your call, no? Unless you're too busy maybe doing a podcast.
Which he's been very busy doing, which I've listened to, which wasn't too bad, to be honest with you. I know a lot of people have criticised it, but I don't think it was too bad. The one with Charlie Kirk was the first one, right?
That was the first one. I've seen rollouts of it on Twitter, the second hand that made it Twitter, but
It's
I'm
like
not
watching him slowly become conservative in that first one. Anyway,
He was convinced by the end of it that he was almost
very quickly
agreeing with Charlie Kirk.
Up next on the programme, Team Transitory gets the band back together.
It's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored.
Up next on the programme, we'll catch up with the former Kansas City Fed President Thomas Hoenig. From New York City, this is Bloomberg. So here's the state of play. Just a little bit more defensive this morning. Equities negative by 0.4% on the S&P, and bond yields down by 4 basis points. The 10-year getting away and breaking out of that range. The 10-year down to 420 so far this morning. Under surveillance this morning, Team Transitory gets the band back together.
It can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
So here's the latest this morning. The Fed Chair Jay Powell alleviating tariff concerns, saying the levies might only trigger a one-time price hit. We can lean on the expertise and experience now of the former Kansas City Fed President, Thomas Hoenig. Thomas, welcome back to the programme, sir. We'd love your assessment of yesterday. It was a three-part act, the decision, the news conference and the new projections. How would you summarise things?
Well, I think, number one, yesterday was not a surprise to anyone. Everyone knew that they were going to hold constant given the level of uncertainty. I think also for me, it was not at all surprising that they backed off quantitative tightening, bringing it down from $25 billion to $5 billion a month. And that reflects their concerns about liquidity in the market, given the uncertainties that the tariff brings on, that the fiscal situation brings on. So they did, in fact, ease relative to their quantitative tightening program. And I think that's important because that brings liquidity into the market. So no surprises from my perspective. I think, right now, everyone's talking about the tariffs. That probably is one time, depending on so many things. Whether we really get in a trade war, tariffs trade war, that could extend it and make inflation more difficult. The other thing that no one's talking about that I think is every bit as important is the fiscal situation. Our debt is going to go up again. That's a big deal in my mind relative to what the Fed will do in the future.
So hold on a second. It sounds like, Tom, you don't necessarily buy the idea of transitory inflation on a wholesale level, maybe with respect to tariffs. But on a broader level, you think that it's not quite the same argument that inflation wholesale is as transitory as maybe it otherwise would be without that kind of deficit overhang. Is that correct?
That's what I'm saying. There's a risk here. Number one, think about it. We have huge debts coming forward. If we get through the transitory tariffs, that would be fine. But we're going to spend a lot more money again as a nation. The Fed's going to have a lot of pressure from this administration and from the economy more broadly to monetize some of that and to help the banking industry monetize that debt that's going to be coming on board. That should put inflationary pressures up higher. And number two, remember that they keep saying that policy is restrictive, but real interest rates are in the 1.5% range. That's not particularly restrictive in a historical context. So I don't think we should be all that sanguine if we get through this tariff that we're home free. We'll see. I hope we are, but I have some reservations, yes.
It sounds like you disagree on several fronts with some of what the Fed put out yesterday. First of all, the idea that they forecast inflation coming lower after this year, that one-time bump. And then also this idea that going forward, you're going to have slowing growth, but it's not going to be some sort of downturn, that it's going to be sanguine. Do you think that it is setting up for a policy error, that the Fed is looking through inflation as a short-term phenomenon without considering some of the fiscal overhangs that you're talking about?
Well, let me put it this way: they're not talking about those issues. They're focusing in on the tariffs, which everyone is. But monetary policy is supposed to be a long-run process, and you have to think of where you are a year from now, but 2 years from now, and they're projecting everything just comes right back into normal. But I think that they won't talk about the fiscal problems we have in this nation. That's a big deal, and I think the Federal Reserve will be under pressure. So, I'm not sanguine about the long run at this point, given the absence of discussion about one of the most important things this nation faces, and that is a growing, huge national debt problem.
Last night, the president did tweet that the Fed would be much better off cutting rates as U.S. tariffs start to transition, his words, ease their way into the economy. Does it bother you that this president still takes to social media or talks to the press and tries to dictate what the Fed should do?
Well, I don't know if he's dictating or if that was this is my view. There's nothing wrong with that. Look, everyone has a view about what the Fed should do. I don't have any problem with that. Now, if he forces it and starts threatening it, that's a different story. But I think, and with that in mind, why shouldn't the Fed, I think, be talking about fiscal policy? It makes their job all that much more difficult. So why shouldn't the Fed be saying, Congress, we're worried about the debt. This is an issue. It'll affect our ability to control inflation. Work on that. So I don't. It doesn't bother me that he does it, so long as he doesn't force it down their throat.
Tom, I want to pick up on one point that you put out there where you talked about the pressure to monetize the fiscal deficit down the line should that become untenable. And I just wonder if you actually think that is a likely outcome where essentially as the U.S. deficit becomes larger, in order to offset that and lower longer term yields, the Federal Reserve will expand their balance sheet once again. You think that's feasible?
Well, I think they'll have pressure to do that, yes. Whether they do it or not, I don't know. But I hope they don't, and it's not feasible, and that they make that clear. But think about it. We're going to add $2 trillion more of debt this year. We have to turn over debt. There's going to be upward pressure on interest rates from that, and the Fed will be under a lot of pressure to reduce that. And that's really what has happened over time relative to causing or allowing inflation to break out in this country. Yes.
Hey, Thomas.
Your concern.
Lucky to catch up with you this morning, sir. We appreciate your time. Thanks for being with us. The former Kansas City Fed President Thomas Hoenig there, leaning on some of his experience at the Federal Reserve to think about where we are for this Federal Reserve in 2025. And Bob Michael at JP Morgan Asset Management, I think, framed it really nicely going into the decision yesterday about how much of a moment this really was for this Federal Reserve. A challenge, the central banker's dilemma, when you have downside risk to growth and upside risk to inflation.
Which do they prioritize? And yesterday in the press conference, it seemed like there was more of a focus on downside to growth simply because inflation was transitory. There is a caveat here, and this is something that Thomas just brought up. Is it just inflation tied to tariffs that's transitory, not necessarily some of these other overhangs? The projection seems to suggest it's all inflation, but that's an important thing at a time where you can't really scientifically parse out what's tariff inflation and what's related to some of these other
He acknowledged that, didn't he?
Exactly.
In the news conference. So if you get a bounce later this year, that's going to be an interesting one.
Correct.
He turns around and says, we can look through this, we can respond, but you said it's very difficult to understand what's the difference between the two. So how do you know?
And how do you look through it at a time when previously transitory has turned out to not have been a successful band, at least on the Hot 10 list?
Yeah, it's been very difficult. The band's getting back together.
Yeah, well, let's see if they can stay together.
Great song, isn't it? I wasn't expecting to hear it yesterday, I have to say. I was surprised by that.
The transitory?
Yeah, just to throw out the T word.
Let's hear what the beat's like.
It's becoming a big distraction. But maybe that was the intention. Coming up next on the programme, Greg Boutle of BNP Paribas, Brooke Roach of Goldman Sachs, Luke Tilley of Wilmington Trust and Matt Brill of Invesco. The third hour of Bloomberg Surveillance. Up next.
It can be the case that it's appropriate sometimes to look through inflation if it's transitory, and that can be the case in the case of tariff inflation.
Everyone's relieved that the Fed didn't jump to significant conclusions.
If we get to that May 7th meeting and they do not find a reason to cut rates, they're not going to find a reason to cut rates this year.
I don't think there's any chance that they cut in May.
The question is how much of a growth deterioration needs to occur before the Fed can react, and it seems to be that the bar is pretty high for that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
I really don't remember the last time we had this much debate about how to interpret a central bank decision from the Federal Reserve, but we had tons. For this market, though, it was absolutely convinced yesterday that it was bullish. Equities off to the races, rocketing higher into the close. We were gaining by something like 1% on the S&P 500. Session highs, we were pushing even higher than that in the middle of that news conference. This morning, we pulled back on the S&P 500, just a little bit softer by a third of 1%. On the Nasdaq, down by 0.5. The next hour is all about the economic data. 29 minutes from now, we get jobless claims. Jobless claims in America, 8:30 Eastern Time. For now, though, we need to talk about another central bank decision. And this time, Lisa, it's the Bank of England. Interest rates unchanged at 4.50.
Yeah, as expected, with 8 voting for this and 1 dissent. This really is a fascinating decision because of its lack of interest, frankly, how much it's the same as previous iterations. Rates are on a gradually declining path. The Bank of England says a gradual and careful approach to easing is appropriate. But this is fascinating, moving in the opposite direction, raising their first quarter GDP growth forecast to 0.25% from 0.1%. So you will see this moving in the opposite direction in a very confusing mix of trade headlines.
Let's head down to the Bank of England, just outside of Threadneedle Street, across the road from the Bank of England. Joining us now is Lizzie Burden from the City of London. Lizzie, welcome to the programme. Just break down how the vote shaked out in the end and what you're looking for in the headlines.
Well, John, as expected, this is a hold. It's interesting that it's an 8-1 vote split. Catherine Mann going from Archhawk to Archdove, voting for a jumbo cut, and today for a hold. So completely changing her tune. But in recent weeks, she has been emphasising the need to keep policy restrictive and echoing the theme across the Monetary Policy Committee that caution needs to be the watchword here because of all of the uncertainty around tariffs and trade policy coming out of the US, and then the second round effects of that on inflation expectations and wages and prices here in the UK. It's interesting as well, Lisa, that you pointed out that growth forecast upgrade. I am sure that is going to be very, very welcome over on Downing Street. The Chancellor, Rachel Reeves, preparing for her spring statement next week. And of course, growth, the Labour government's number one priority. But as well, interesting that they've maintained that guidance that the rate path ahead is going to be gradual and careful. So not a lot of change here. No press conference today, no forecasts, and pretty much what was expected.
Lizzie, that spring statement taking place on Wednesday next week at a time when the Germans are easing fiscal policy and easing things potentially aggressively in the coming years. How much space does Chancellor Reeves have in the coming 12 months?
Put it this way, John, Britain is broke by comparison to Germany. Rachel Reeves does not have the same set of options that Germany has when it comes to increasing defence and infrastructure spending. I was speaking to her on Monday, and interestingly, we had a conversation about her headroom against her fiscal rules. She left herself a razor-thin margin back in October. That's been wiped out now pretty much because of the gilt yield moves. And she emphasised heavily, actually, the need to build up that fiscal cushion again. And that's been confirmed by our colleagues on the Economics and Government team, Phil Aldrich and Joe Mays, that actually she is going to leave or even build up that £9.9 billion headroom. It comes, though, from spending cuts, which for many harks back to the Conservatives. And to me, what's fascinating about that is it seems like she's more concerned about the bond vigilantes than she is about upsetting the left wing of the Labour Party.
Lizzie, appreciate the update. Great work as always. Lizzie Burden, outside of the Bank of England in the City of London. A few headlines to go through. I'll share them with you now if you're just joining us. 4.50, the interest rate at the Bank of England. Bank rate remains unchanged. The vote, here's the breakdown for you. 8 voted for no change, 1 voted for a quarter-point cut. The approach, let's talk about the approach from Governor Bailey. He says the approach will be gradual and careful, but interest rates are on a gradually declining path. That's the Bank of England this morning.
Yeah, and upgrading the growth forecast to 0.25% from 0.1%. I will just say that one terminal user messaged in, it's like wanting an ice cream sundae and your mom gives you a baby bite of vanilla ice cream. Not enough because 0.25% isn't something to really celebrate still. I thought that was notable since it was in the opposite direction of what everyone else is
Someone's tortured childhood. Is that terminal subscriber?
All I can say is I relate.
Isn't it like being promised a banana and actually getting some ice cream?
Well, I mean, look.
Isn't that the growth forecast?
Thank you. I think that is the correct way to look at it because ultimately it is welcome and is the opposite direction. And frankly, on Downing Street,
there you go. We'll take some of that.
I'll take a little taste of ice cream. It's sweet.
Love some ice cream. Right now, breakfast. Anyway, equities right now in the S&P, down about 1/3 this morning as Fed Chair Jay Powell downplays inflation risk. Greg Boutle of BNP Paribas writing, we see the driver of the market switching from systematic to discretionary flows. If the market bounces, we think it could be a shallow bounce and one to fade. Greg joins us now for more. Greg, good morning. Good to see you. We're fading that bounce. We're fading it this morning. It got faded pretty aggressively in the last couple of hours or so. What did you make of yesterday? Let's start there and then we can go through the rest of the stuff.
Yeah, I think it was a relief rally for equities that we didn't get anything from the Fed that I think really changes the bigger picture for equities, but neither did we get anything that was negative. So, our view is that we could have a bit of a relief for equity markets this week as some of the positioning got very washed out last week. And I think the absence of anything negative from the Fed was really seen as a positive.
In the forecast, though, to put out forecasts and downgrade your outlook for growth to the extent they did, and to not see the median dot move lower with it, in fact, to see the distribution of the dots have a more hawkish skew, that can't be bullish, can it?
No, I don't think standalone that's bullish for equity markets, but I'm not sure how much of a surprise it was for the market either. Concerns around growth have certainly picked up this year, and to hear that kind of reflected by the Fed, I think is a little bit more of the narrative that has given US equity markets a troubled start to the year.
Before we try to understand the mystery that is a confused and in the dark Fed, I want to understand positioning and where we are in the sort of unwind of the trade that had been the momentum stocks. Are we done with that? I mean, if we washed that out, now we're responding to the concepts of stagflation and what kind of response we could end up getting from, say, the Federal Reserve.
Yes, the way that we think about these things is in different stages and different buckets of investors. So when we look at positioning, we can split that into things like systematic investors, long-short hedge funds, and more directional investors. And what we've seen is certainly that systematic part of the market looks very washed out. So we saw some huge outflows from CTAs, volatility target funds, levered ETFs that we think were more than $100 billion of outflows over the last month. We think that those are largely washed out, and there's a more benign outlook for the next couple of weeks. Now, what that doesn't answer is the bigger question of what are discretionary investors going to do? What do they think about the growth outlook? We saw huge inflows into equities at the end of last year. So the question is whether it's the corporate picture or the macro growth picture has enough change there to drive those investors to change their behavior. The answer is not yet.
If there's an international ball of money and it's kind of washing around different places where it thinks that it's going to be treated best, does the Fed cutting rates potentially by 25 basis points in the face of truly weakening growth entice that ball of money to the United States?
I don't think so. The question around how the market reacts to the Fed is always, why are the Fed doing what they're doing? So if you have a modest slowdown in growth and you have a deep cutting cycle from the Fed, that's something you think would be bullish for US equities. Whereas if you have a shallow cutting cycle from the Fed because growth is deteriorating, then that's less bullish.
What would be the catalyst for the market to really start to rally?
So
you say it's about a confluence of all these issues, which we're not really going to have any solutions to, at least in the short term.
Yeah, that's kind of the thrust of how we're looking at the market in the short term, is that you can have a relief rally if the news flow from the Fed is better. You can have a relief rally if the feedback from the NVIDIA event this week was a little bit better. But if we're worried about trade, tariffs, fiscal uncertainty, monetary uncertainty, growth slowing down, the consumer, it's hard to see all of those things kind of alleviate or the concern alleviate at the same time. This is why we think we can have these kind of pockets of relief rally, but it's very hard to see the market go on a kind of sustained move higher to make new all-time highs without really seeing a lot of things change in terms of the outlook.
What would the market need to hear on April 2nd in order to have maybe a sustainable relief rally?
So I think anything which kind of calms people's expectations that tariffs ratchet and we have further retaliation and it becomes this kind of tit for tat. But I think that even if we saw something that calmed the markets regarding tariffs, to the point, it's not going to clear the decks of everything the market's worried about. We're still going to have to get through the next corporate earnings season. There's some signs of slowing there. We're still going to have to address some of the issues that have weighed on large cap tech this year. So I think confluence of events is why we think it's hard.
Let's get to the earnings. I'm pleased you brought it up. Delta Airlines in the last few weeks, I think it's probably one of the most important data points we've had. It's not just soft data. The CEO, Ed Bastian, of the company are coming out and saying Q1 won't be anywhere near as good as we thought it would be because consumer and business activity stalled in the middle of February. Can the hard data get any harder than hearing that from Delta?
Yeah, so I think one of the things that ultimately we think is always most important for equity markets, away from policy, away from macro, is always going to be the corporate earnings. If you see corporate earnings disappoint, it's very unlikely that the equity market's going to do anything other than have a tough time. And I think when we look at this earnings season, it's notably been a more challenging one, the prior earnings season that we've been through, than what we've become accustomed to. And I think that's been broad-based. So some of the kind of cyclical bellwethers, things like Delta, but we also saw some downgrades in some of the more secular growth stories at the start of this year as well.
How do you judge whether they're just sandbagging us? And I say this because, no, I'm serious, because they talk about transitory. I think it's transitory, but we're going to really lower the bar so we can jump across it later. I mean, how much is that part of what's going on? And, I say that partly because how can we really judge an outlook that's based on the dark room that we're all in blindfolded?
Well, I think the real answer is that we can't. And whether it's trade, tariffs, monetary policy, John's questions on earnings, it's more questions than it is answers. So this is why we think we're going to be in this environment where it's heightened uncertainty for equity markets, which drives more volatility, and it makes it much harder to sustain a rally. We think hedging is something that investors should be very focused on at the moment.
I don't think Dow's a forecast, though. It's realised. They're telling you what happened in February. That's the difference here. You can say, OK, I don't believe your outlook, you're sandbagging us, you're lowering expectations. Perhaps they are. We've seen a lot of that from the retailers, and we'll talk about Nike on that front in that regard in just a moment. But with Delta, they told you what happened in February. So the softness, the weakness is not just survey data. They're seeing it in actual activity.
Yeah. The only caveat to that, and I'm with you, I'm 100% on the Delta was the biggest data point probably of the past month. The one caveat to that is it's not falling off a cliff to that extent.
It's true.
And so it's not that people aren't traveling. It's that it's seen a significant downdraft. And he said that he expected that to be alleviated when people feel good again and then just need a vacation. So, there is that.
We're always on the same page. For equity markets, though, think about this. So GDP's come down from 2.5% to about 1.5%. And we've repriced GDP forecast in, the space of a month? So we've come down almost 1 full percentage point compared to what the street was looking for at the start of the year compared to now. Now, I want to understand from your perspective, Greg, just to wrap it up, in a world where you're downgrading growth that way, do earnings typically come in a way that supports equity markets?
No, I mean, the simplest thing is to look at nominal GDP growth relative to earnings, and the two are pretty well correlated. So if you're bringing your growth forecast down, it's unlikely that you're taking your earnings forecast up.
Have we brought our earnings expectations down sufficiently to account for that?
No, I think earnings forecasts have come down somewhat, but they've retraced from what were pretty optimistic expectations at the start of the year.
Greg Boutle of BNP. Greg, appreciate it. Thank you, sir. Lots to think about, I know, and there's so many different conflicting data points that we all need to grapple with in the coming weeks.
Your point is a very smart one. Either earnings expectations have to come down or those Wall Street firms have to go back to the revisions and revise them again back upwards. But something has to give because that delta's getting wider.
This is what this equity market's been responding to, all of this over the last several weeks or so. Futures right now down by about 0.4% on the S&P. Let's get you an update on news elsewhere with your Bloomberg brief. Here's Yahira Hacker. So, Yahira.
Hi, John. Turkish markets are showing signs of stabilizing after authorities stepped in to offset demand for dollars following the detention of President Erdogan's main political rival. Because of this, you are seeing the lira recover against the dollar, while the main stock index rose 1.1% today. But as you can see, still has not recouped all of its losses from yesterday's plunge. Meanwhile, Canada's foreign minister says China has executed 4 Canadians holding dual citizenship on drug-related charges this year. The executions further straining ties between the nations, with China saying Canada should respect its laws and not interfere with its judicial sovereignty. And the White House is considering extending Chevron's license to pump oil in Venezuela, reversing a recent push to have the company wind down operations next month. The Wall Street Journal reporting Chevron CEO Mike Wirth met with Trump at the White House yesterday as part of a larger gathering of energy executives. That's your Bloomberg Brief. John?
Hara, thank you. Appreciate it. Up next on the programme, the Morning Calls Plus. Brooke Roach of Goldman Sachs ahead of Nike earnings after the closing bell. That conversation up next. Live from New York City, that opening bell 1 hour and 15 minutes away. Equity futures just a touch softer. We're down 0.4%. The opening bout just around the corner, 1 hour and 13 minutes away. Equities a little bit softer compared to the rally that we got yesterday going into the close. In that Fed meeting, unleashing a 1% rally on the S&P 500. The S&P this morning down by 0.4%. The Nasdaq down by 0.5. Let's get you some morning calls. First up, UBS upgrading Southwest Airlines to neutral, noting the potential for improving financial performance. Their stock is higher by 0.6%. Your second call from Piper Sandler, downgrading Rivian to neutral, warning the EV maker is exposed to a, quote, potential triple whammy of policy risk That stock is down by 1.85%. And finally, Morgan Stanley lowering its price target on Five Below to 110, saying tariffs present a significant margin headwind. That stock this morning still just about positive. It's up by 9% in early trading. Let's stick with retail. Investors looking ahead to Nike earnings for another read on the state of the U.S. consumer. Brooke Roach of Goldman Sachs writing, "We believe it is still early in Nike's turnaround journey, and we have yet to see material signs of brand heat improvement." She has a buy rating on the stock with a $90 price target. Brooke joins us now for more. Brooke, welcome to the program. Let's get into it. What are you looking for later on today?
Good morning, and thank you for having me today. We believe that all eyes are on Nike's earnings result this afternoon. And as we look to the report, we do believe that focus is centered on signs that the brand turnaround is working. New CEO, Mr. Elliott Hill, outlined several strategic actions taken to improve the brand over the course of the past couple of quarters. And we believe that you're starting to see signs that those actions are taking root. We have seen some refreshes in marketing. We've seen some changes in promotional activity, and we've seen some signs that they're looking to reduce discounting on Nike.com. As a result, all eyes are on any signs that fiscal 26 may be able to return to growth and what the impacts of recent changes might have on sales growth and earnings.
What's the growth market, Brooke? Is it going to be the United States? Is it going to be overseas at a time where there's a real question about that? Will it be trying to rehitch its wagon to the NFL?
I think one of the big questions is whether or not they will be able to return the North America market to growth. We believe that the reset in North America is very important. We are seeing signs of improved marketing. We are seeing signs of improved innovation. And we are seeing some signs that the North America consumer is engaging with that improved marketing and innovation. Generally, in our sector, when markets begin to improve in North America for retail brands, we start to see signs that brand heat can translate internationally. So we believe investor focus will be very centered on North America.
The big counter argument is on holdings, is the potential increase in hokas, is the fact that in all the running groups that we all see in the morning in Central Park, there isn't necessarily a huge domination of Nike shoes. Instead, there are a whole host of other brands. At what point does that become a real problem? Because there are these competitors and they're scrappy and they're getting in.
We are seeing a lot of signs that Nike is refocusing on innovation across each of their core sport categories. The new CEO is focused on returning the brand to focus on sport and to engage with those core running communities and those core sport communities. As a result, we've seen better innovation with more new product. We've seen the launch of the Pegasus Premium and the Vomero 18. And the company is refocusing on engaging with those local communities and with specialty retail running. So we believe that they are starting to make the steps that are necessary to return to competitive market share positioning in each of those core categories.
Brooke, even if they have a better product, what's to say people are buying? Dick's Sporting Goods, they expect a sales slowdown at the same time that surveys continue to say that consumers are worried about the uncertainty that's coming from policy in Washington and the tariffs.
Overall, we have seen signs of some consumer slowdown and macro choppiness over the course of the last few weeks. At first, there was some focus on the potential that this was a function of weather, but overall, we have seen some more comments about slowing overall. I think as we look at Nike's turnaround story, investors are much more focused on what will happen in fiscal 26, which will be beginning in June of this year, and what Nike can do on a relative competitive positioning to improve the brand heat so that they can gain back that market share regardless of the macro backdrop.
So is basically what you're saying is 2025 is going to be really a period of transition for Nike to then potentially nail it in 2026?
We believe that the company will be returning to growth in the back half of their fiscal 26, and that many of the actions that have already been outlined by management are going to drive lower sales and lower margins in the first half of fiscal 26 and thus calendar 25.
There's a challenge still to come. Brooke, appreciate your time to break this down for us. As always, Brooke Roach there of Goldman Sachs on Nike. Nike so far in the month of March down 8%. You mentioned Dick's Sporting Goods down double digits so far this month, and that's the concern.
Because Dick's Sporting Goods is saying that they're seeing a sales slowdown for this year of 5 to 7%. So even if Nike had a product that everyone was buying, like you mentioned, those running shoes or Hoka's, people are pulling back and they're potentially not even buying it, let alone the fact that Nike's not having something that's really exciting consumers right now.
What this conversation did reveal, though, that there are some companies who are better than others to reveal where the consumer is at right now. This is one of those situations where if Nike comes out with weak earnings, and I've got no idea what the results will be a little bit later, but people will say there's structural issues, there's idiosyncratic problems with Nike. It's not a clean read on the US consumer.
That was my takeaway as well. This is one that's been trying to reclaim its spot in the sports attire race, and it's having a hard time because the race has changed. Not only do you have these upstarts, you have resale platforms. You've got Walmart getting in on that in a massive way. You have all sorts of new ways of distribution that they've been playing around with in terms of, are they in stores? Are they out of stores? How do they deal with this? And that's going to be challenging for them when you have others that are really making real terrain.
They slipped post-pandemic and they're struggling to get back up. That's for sure. Need to reset a little bit in just a moment at 8:30 Eastern time, so 6 or 7 minutes from now, we'll get US jobless claims. This is another read on the US labour market. I'll share the estimates with you. 224 is the estimate for claims. The previous week was 220. So we're not looking for deterioration in the headline number in just a moment. But every single week, as the fears about economic growth and potentially a downturn continue to build, that data point becomes more and more important.
And people will be parsing it more and more carefully to understand exactly where the layoffs are coming from and whether the stagnant labor market is starting to break in the wrong direction. One thing I'm looking for is continuing claims, because that is the people who are receiving jobless claims benefits over a longer period of time. That is expected to tick up to one of the higher levels going back several years. So if you start seeing that kind of trend, how much do people extrapolate out?
That would speak to the anxiety in the labour market right now. That people are worried about their ability to go and get a job if they're out of work. That would speak to that directly. We also saw anxiety around unemployment start to climb in UMich. Now, I think you could sit here and say UMich is not that important, it's driven by politics, but we've seen several echoes of that in other data points as well.
And also, even in this most recent UMich, they said across political demographics, most consumers were saying that they are feeling a little bit angsty and uneasy. What I care about jobs lately is what is coming out of Washington. How much is Doge actually cutting, and is it hitting the hard data, all the pronouncements we're hearing from Elon Musk?
The Beige Book, and you mentioned this, actually, because you actually read it this time and thought that it was interesting.
Blaming Annmarie.
I'm blaming Annmarie.
It got interesting this time.
Oh, it's always
usually
interesting.
Beige. This time it was a bit more exciting.
What was it? Pink? Let me just tell you, I think it's always pretty interesting, but this time around it was actually especially interesting. And you pointed to the anecdote that I thought was really compelling, which is the stack of resumes on people's desks looking for jobs. That is a change after a long time where that labor dynamic was very different and speaks to sort of things becoming a little bit less balanced.
Psychology shifts quickly, doesn't it? I'm kind of pushing against that, just making sure that people just stand firm, stay strong, keep asking for more.
That's your rallying cry?
I just think that once psychology becomes informed that way, the leverage shifts even more aggressively.
Keep going with that.
Ask for raises.
Yeah, yes. Keep going with that.
Maintain your confidence in your self-worth and all of that.
Keep going. I love this.
I'm not going to throw cold water on this. I didn't read anything. I was in bed at about 6:30.
Lucky you.
Up next on the program. Jobless claims just around the corner. Luke Tilley of Wilmington Trust joins us. Matt Brill of Invesco as well. Mike McKee's going to break it down. The opening bow 60 minutes away. Equity futures on the S&P down by 0.4%. On the Nasdaq 100 down by 0.6. In the bond market, just ahead of jobless claims, your scores will look like this on a 2-year, 10-year and 30-year. The 2-year is down by 5 basis points. The 10-year is down by 6 at about 4.18. A break of 4.20. We've got a gap lower on a 30-year yield as well. We're down by 6 basis points. With your economic data, let's cross over to Michael McKee. Good morning, Mike.
Good morning, John. Well, we are getting the first numbers in maybe from the Philadelphia Fed. Oh, here come the jobless claims numbers. 223, just below the forecast, just above what we got last week, which was 221,000. Now, the interesting thing in the numbers this week is that the number of people who are claiming federal unemployment benefits for the first time fell again to 1,066. 2 weeks ago it was 1,600, and now all of a sudden we are seeing much fewer. And that may be because a lot of these people, if they are getting laid off, are getting some kind of severance, and they can't claim until that point. Continuing claims were, 8,215 last week. So a slight rise there, but basically we're not seeing a lot of the federal Doge layoffs having an impact. Now, Philadelphia Fed did come in higher than anticipated, 12.5. The forecast was for 9, but this is down from 18.1. And the thing that everybody is looking at on these regional indexes is prices paid. Prices paid go up a lot, 48.5 after 40.5 the month before. So still some inflation pressure, no problem with the labor market, and it seems like Mr. Trump's tweet is not going to affect anybody at the Fed, given these kind of data.
I wouldn't expect it to right now. Mike, just to sit on the jobless claims number and compare it to continuing claims, are we seeing any subtle signs that once you're out of work, it's harder to get work?
Not really, not yet. It's slowly creeping up, but 1,859,000 last month, 1,892,000 this month. So it is getting a little bit harder, perhaps, but overall, it's still a sign of a labor market that is relatively healthy.
Mike, thank you, sir. Echoing what we heard from Chairman Pyle pretty much directly in that news conference yesterday. So that's the latest economic data. Lisa, just to go through the bond market, yields are lower, down 3 basis points. The 2-year 394, the 10-year just a break of 420.
Yeah, not a huge reaction given the fact that we didn't really learn anything that we weren't expecting in this data. I do go back to this question about what the lag time is between the soft data and the hard data. This is something that Mohamed El-Erian has talked a lot about, that usually there's a 3 to 6 month lag. It seemed to be poo-pooed by Fed Chair Powell. Right now, the hard data is not showing us a real sense of alarm, even though the survey data is suggesting it.
And to Mike's point, what's the lag data for the Doge effect? Because you're not seeing it show up right now. And to his point, potentially a lot of these individuals that were laid off with the federal government got severance pay. So they might not be able to go and ask for a claim. When do we start to see that impact the data?
That's the latest on the economic data front. Let's get back to the chairman of the Federal Reserve and the decision of the last 24 hours. Luke Tilley of Wilmington Trust weighing in on that decision, writing the following. We continue to think the labour market and inflation data would justify a rate cut at the May meeting, but given Fed Chair Jay Powell's response, we are moving our first expected cut to the June meeting. Luke joins us now for more. Luke, welcome to the programme. I want to build on what we heard just yesterday from Chairman Powell with you in just a moment. I want to start with the forecast, though. What was your initial reaction to the adjustment in the S&P that we saw relative to December?
Yeah, well, the big change, obviously, is to the GDP forecast and that coming down. And I think that incorporates what we had been expecting, is that the strength of the consumer at the end of last year was not really strength in the sense that the consumer keep powering the economy ahead. What we saw was really strong spending on durable goods in November and December. That was coming a lot from replacement purchases from the storms, and then also people getting ahead of tariffs. So there was a lot of people at the end of last year that thought the economy was just up and away, you know, in this sort of almost like a no landing scenario that was going to generate inflation. And of course, we've seen consumer spending come back down in January, retail sales down in January and February. And really, the more accurate picture is a consumer that is, you know, it's doing okay. It's pretty solid, but it's going to decelerate. And that's why I would expect GDP to come down. We've had a 1.8% forecast for 2025 for a while. So the Fed now is very close to that with their 1.7.
So, Luke, growth comes down, inflation goes up. And it's that piece of it that's interesting. So from a market perspective for investors right now, they want to know if this Federal Reserve is in a position to respond to deteriorating data if we do get that weaker economic data. Are they constrained somehow by higher inflation prints? What would you say to investors this morning?
Well, we've had the same story for a while now, and it's that the consumer was not strong enough to keep pushing inflation higher, nor was the consumer strong enough to take on increased prices of imports and drive inflation higher. We thought that basically if you raise the prices on imports, that they would start spending less on domestic services, like going to the movies or haircuts or restaurants or anything like that. So we really didn't perceive that there was an inflation problem. We've been messaging that for quite some time now. I think the Fed in a good way, was talking very differently about tariffs yesterday than 7 weeks before, acknowledging that the increase, a tariff increases the price of a good, but that's not necessarily inflation. It's only inflation if consumers can handle it and they're ready, willing, and able to keep paying those higher prices and keep spending elsewhere. And that's sort of what it sounded like at the end of January, the previous FOMC meeting. But of course, the messaging yesterday, as you've pointed out earlier in the program, very different. Basically, a step level one-time increase in prices of those imported goods, but we wouldn't expect it to generate inflation that would go on.
Okay, so Luke, it seems like you're actually on board with that, and yet you think that the Fed took May off the table in terms of cutting rates, in part because they are looking at the hard data. Do you think that actually this increases the chance they're going to be behind the curve if you do think that the soft data is indicating a much faster pace of deceleration economically?
It feels a little bit like last year. I think we were probably the last people to take July off the table last year and say, well, they're not even really leaving the door open. And then when they got to September, of course, they cut by 50 basis points and they had to play some catch up. I think yesterday it was in response to a direct question about May. And Chair Pyle said, we're not in a rush, and so that's about as clear as a Fed chair is ever going to get about we're not going to cut rates at the next meeting. So that's why we have to push our first cut out one more meeting. I also don't think it's hugely important. The economy is not going to hinge on 25 basis points over the course of 7 weeks. But as I said, and as you read in the quote at the beginning, I do think that the economic data will justify a cut by May. We're going to keep seeing slower job growth. We're going to see slower consumer spending. I think the inflation data will keep slowing down. So it'll justify that, but that'll be fine. As long as they're talking about it at the May meeting, that should ease financial conditions.
We have this near-term data, and John was talking about the Delta earnings and the call about how much demand has been dropping off. We've heard that same thing from other companies that cater to consumers, and raises this question, how far behind is the hard data? We don't see it in the jobless claims. We don't see it in a lot of other data points that have been coming out from the government. At what point do you expect to start seeing this in the data, or can you dismiss this as watch what they do, not what they say? And those two things can be very different.
Yeah, I'm definitely a fan of watch what they do and not what they say. And I don't really think we're looking for a deterioration in the hard data, signaling recession or anything like that. If you just look at year over year retail sales, year over year consumer spending, it's at pretty mundane, normal levels that we had in 2018, 2019, when inflation was not a problem. And I think that hard data speaks directly to that. The labor market's going to be a lot more interesting. We think that the job openings are going to continue to decline and jobs are going to slow down. One of the interesting things here is that because of the uncertainty of the tariffs, we do expect firms to maybe hold off on hiring. And that dynamic, it wouldn't actually show them cutting their open positions. Just sort of, hey, HR, let's wait a little bit and see how these things turn off and not pull the trigger on actually hiring somebody. And that's where you would see it come through. So it's not going to show up in the JOLTS data right away. But one thing that we have seen, even though the job growth is okay, you're not seeing the unemployment claims, we're seeing shorter work weeks. It's 2 months in a row now that the average work week is really low. And when you combine that with slowing job growth and slowing wage growth, and you look at just total wages paid, that's at the slowest growth rate that it's been since the pandemic. So it's really starting to slow down, but it's like seeping in kind of sneakily. Because it's just basically lower wages being pointed out. You've got reduced overtime hours and that reduced work week. So in some ways, it is coming through in the hard data. It's not pointing to recession, but it is a slowdown, and I don't think generates any inflation pressure.
Luke, you have a recession probability of 35% and GDP of 1.8%. What I find so interesting about your call is it's the call you had around the time of the election next year. Meanwhile, everyone has really revised what they're thinking about growth and also potential recession because of the tariff story. What did you see in November that people are starting to catch up now?
Slowing labor. There was slowing labor demand all of last year. It's going to slow down the hiring. We're looking at job growth that is coming in at around 150, and you've also had a significant contribution from government jobs last year. So when you look at private payroll growth, it was slowing down already through the second half of last year. There were some strong consumer spending numbers, but like I said a few minutes ago, I think that those were a little bit of a head fake. And if you think about what's going to end up driving consumer spending, it's not savings. There's not many savings left. It's going to be job growth and wage growth. And when those things are slowing down, you're going to have a slower economy. It's going to fall down below 2% this year. That's how you don't end up with any inflation pressure. So I will say last year, at the end of the year, it was incredibly hard to read through some of the impacts. There were multiple hurricane events, storm events, the election, people getting ahead of tariffs. So you really have to be looking at longer term trends and not hinging on one particular data point. But this is that slowing is what we've been seeing for quite some time, Annmarie.
A lot of people are catching up with you. Luke, appreciate it. Luke Tilley there of Wilmington Trust. Neil Dutta of Renmax saying almost precisely the same thing coming into 2025, saying the tariff blame game is overdone. There's more than just tariffs going on here.
There is a slowdown in the consumer after spending quite a bit. People talk about the slowdown in retail sales in particular as having to do with just how much they spent last year. But also, people have been traveling everywhere. People have been spending everything. And at a certain point, it seems like this year is sort of the sobering year, the sobering up year.
Post-pandemic hangover.
I feel like that's what's happening. I think so.
This is what Neil and the administration talks about. There is this hangover. And before the tariffs came into the play and center stage, you already saw a slowdown. There was weakness in the economy. But now, what Neil would say is this isn't a lazy excuse for economists and analysts to use the tariffs as the reason why they may have to really look at their growth outlook and rate it downwards.
There's a difference between a hangover and a detox, though, right? Not to go too deep here, but ultimately the administration's talking more about a detox.
That's actually a really good point. A hangover is a temporary sickness that is sort of induced by your
hair of the dog, if you're that way inclined,
exactly.
You know, like wake up and
like
on.
You've had any experience with that whatsoever. But detox is a longer process that takes effort and
speaking with someone with experiences after the hangover, you are hoping you get a detox.
I don't drink. You all know that. Matt Brill of Invesco writes this. Balance sheets are strong and the macro environment is supportive of risk-taking, yet forecasting the remainder of the year has a wide range of outputs. Matt joins us now for more. Matt, welcome to the programme. We've also had a bit of a valuation reset in financial markets as well. An important question to ask, and we asked this at the start of the year. What's our capacity to absorb bad news? Has that improved? And does that bode well for markets for the rest of this year?
Hey, good morning, everybody. And yeah, we actually had asked ChatGPT for a catchy phrase for this market that we're in, and it came out with inflation hangover. So you guys are definitely onto something there. So, as for markets and credit specifically, we've gone wider. So we've adjusted on a valuation standpoint from very tight levels to more moderate, but they're still rich. But if we were to go into recession, credit levels will have to adjust significantly wider from here. So, you talked about 35% chance of recession. That's generally where ours is as well. But the tail risk is certainly fatter than normal. However, balance sheets are in really good shape because companies were expecting a recession for the last 3 years. So everybody's been calling for a recession in 2022, 2023. They kind of gave up on it in 2024, and now we're back at it. So the good thing is they haven't levered up, and so we're in good shape. So I think there's ability for companies to absorb it, not really so much ability for spreads to absorb it because they're already on the tight end of the range.
Which is the reason why a lot of people were surprised, a lot of people being myself, that credit spreads have continued to tighten on these sort of stagflationary mixes, stagflationary light mixes. They're not actually stagflation. And yesterday we saw the same, in particular with high yield contracting yet again. How can you explain that?
So I think if you go back 5 years ago, you had almost to the day. So I remember March 23rd, 2020, you had the Fed step in and start buying corporate credit. So I remember the date because I could leave my office and leave the fetal position for the first time in about 5 days because it was so bad. The Fed stepped in there and it was needed at the time. And we've had a lot of talk around, is there a Trump put? Is there a Fed put? And what I heard from Pyle yesterday is that there is definitely a Fed put that is out there if needed. And they basically told you, or Powell basically told you, I am willing to cut even if I see inflation tick up, because if the economy is slowing, I think that's the more important thing, because I think the inflationary pulses are going to be temporary rather than the slowdown, which could be more severe. So with the Fed telling you that, I think that the tail risk got cut a little bit yesterday. And there's yields where they are. People want to buy. They want to buy. They just need a reason to buy. And Powell stepping forward yesterday gave you a little bit of calmness that he will be there if things get bad, just like he was 5 years ago. So I think that gives you the confidence. But, it's still not all the way there. There's still a lot of volatility. But overall, I think people will buy on any kind of calmness. And that's exactly what we saw yesterday.
Matt, I'm with you that the Fed yesterday cut risk when it had to do with credit, when it had to do with the credit cycle, when it had to do with the economy turning downward. I didn't get the sense that they cut risk when it came to inflation. And inflation over a longer period of time, given that they are getting back on team transitory, and there is this sense that it is going to be a one-time price shock, and down the line, there won't necessarily be ramifications, whether it's tariffs or whether it's not. That's the one kind of fly in the ointment that we've been talking about. Is that accurate? Does that really reflect the releveraging that we're seeing around the world, as well as some of the price pressures that are coming from other places?
So I think your interpretation is 100% correct. You know, the way I would think about that as credit investors, now we're total return investors, but at the end of the day, we are credit investors. Inflation is not the worst thing to credit investors. The economy going into recession is. So that getting lesser of a risk, I think, is better for taking on high yield risk, bank loan risk, IG risk, EM risk possibly as well. Total return and what happens, you know, with the long end of the curve. You actually saw the long end of the curve. It steepened. It was lower, but it did steepen yesterday. So, you know, generally the market is telling you that we'll worry about inflation later. We just need to make sure that we're not immediately going into a hard stop. And that was the takeaway that I had yesterday. Clearly, again, we have a lot of hurdles coming up. I don't want to see an inflationary environment like 2022 all over again. But, you know, Pyle got a little sassy with his comments around transitory, and he pulled out his Caroline Levitt yesterday, and he was basically saying, you know, yes, transitory was different in 2022, but if you go back to the last time there were tariffs back in 2018 and 2019, it was transitory. So I liked his conviction on that. That gave me a little bit of confidence, and I like to see that side of him. That was pretty good.
It certainly hit a nerve. The only thing I would push back to this time around versus Trump 1.0 is, and we were talking about tariffs in 2019, it was about China. Now when we're talking about the president and his policy proposals, it's about Canada, Mexico, the European Union, India. We're talking about everything under the sun, including already 20% tariffs on China. So isn't it harder this time, this environment, and can't the inflationary impact be bigger?
There's a lot going on, right? It's from a lot of different angles. It's really going to be, you know, difficult for the market to adjust and understand. And Pyle basically admitted that. He said, I don't know that I can pinpoint what is transitory and what is not. And you're absolutely correct. With one country, one angle, it was kind of a little bit easier versus if you're getting it from 18 different angles around the globe. I think that will be a lot harder for him to look through. The good thing is, to me, if he believes that it is transitory, which I think he does believe that, and he sees the economy soften, he is going to cut. So that's the bottom line that I took out of yesterday, versus he's not going to be conflicted. He's going to have a very confident approach to it. And I think that's good for credit. Now, it may not be great for overall yields. We'll have to see. But over the near term, I do think that eliminates some severe tail risk to the market that might not have been there otherwise.
Hey, Matt, this was fun. Appreciate it. Thank you. Matt Brill there of Invesco. He was sassy yesterday, wasn't he?
He was on several fronts.
Yeah.
Yes. What would you write? Transitory? Did you just say transitory? I did just say transitory.
Pretty blunt, wasn't it? The press secretary's very sharp, by the way. I mean, I enjoy it. It's great. I enjoy the press secretary. I enjoy it when Chairman Powell's that way. But you do want a forecast from Chairman Powell. Like, none of this, what would you do? I don't care what the people in the room might do. I'm not interested in that.
In fairness, it is a little bit of a difficult situation right now to come up with a forecast. And I think he was reflecting that with a slight bit of, really, guys?
I love Mike McKee, but I don't want his forecast. I don't think Mike McKee wants to offer a forecast. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hacker. Say Yahara.
Hi, John. Amtrak CEO Stephen Gardner abruptly resigned as the Trump administration threatens to pull funding for mass transit systems. Gardner saying he stepped down to ensure Amtrak continues to, quote, enjoy the full faith and confidence of this administration. His successor has not been named. NVIDIA is reportedly planning to invest hundreds of billions of dollars in U.S.-made chips and electronics. The Financial Times reporting NVIDIA will spend around $500 billion in the U.S. over the next 4 years. CEO Jensen Huang also told the FT it can manufacture its latest systems in the U.S. through its suppliers like TSMC and Foxconn. And Tesla is recalling all Cybertrucks produced and sold in the first 15 months the truck was available here in the U.S. This is due to a safety issue with steel trim pieces that come loose because of an adhesive it says is susceptible to environmental embrittlement. Tesla estimates that 1% of the more than 46,000 pickups it's calling back have a defect. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Thanks for this morning. Up next on the programme, we'll run you through the next 24 hours and a week ahead from New York City. This is Bloomberg. 37 minutes away from the opening bell. Equities softer here by 0.4% on the S&P, and the Nasdaq 100 biting into some of yesterday's gains. We're down by 0.5. Your trading during your week ahead is shaping up as follows. At 3:30 Eastern, President Trump signing executive orders after the closing bell. Earnings from Nike and FedEx. Friday, Fed speak from the New York Fed president, Mr. Williams. Look out for that. That's important. Sneak peek of next week, PMI data and consumer confidence still to come. Tyler Kendall joins us now from Washington, D.C. Tyler, the president doesn't stop. More executive orders coming later. What are you looking for?
Yeah, John, two big events today that we're watching. Later on this morning, President Trump is expected to address a digital asset summit in New York. It will be virtual from the White House, but it does mark the first time that a sitting president has addressed a crypto industry conference. We'll be watching there, and whether or not any of those EOs later on today could be related to the crypto industry. And then at 4 p.m. Eastern on the official White House schedule, there is an event related to the Department of Education. Our Bloomberg News reporting that he could be signing an executive order that would direct federal officials to start dismantling the agency. We should note that he can't do this unilaterally. It would take an act of Congress, but the White House so far has already started to pare back funding as well as staffing in the agency as it tries to slim it down, making good on a campaign promise to try to bring education back to the states. We should just quickly note it does raise questions about funding going forward when it comes to the education department.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. It has been non-stop, hasn't it, for the last 2 months?
Absolutely nonstop, and 13 days is the big one. The Liberation Day, as the president was talking about yesterday. I'm interested to see what more tea leaves we get in terms of trade negotiations, because Kevin Hassett said him and the team, Howard Lutnick, Scott Bessent, already talking to countries about maybe them bringing their tariffs down in advance of this April 2nd.
I'm looking at this tea leaf. The EU is delaying its 50% proposed tax on whiskey, American whiskey, to get some of its other, negotiations ready.
It's happening.
It's happening. But also spirits. Why are they in the center? It's like whiskey, champagne. I don't like your teas.
Why are we touching wine?
It's important to people.
Right,
moves
exactly.
the dial on the conversation.
I know, but it'll be.
Don't touch my champagne. Not for me. Equities on the S&P, negative by 0.4.
I've
Coming
had
up tomorrow,
champagne. It's good.
Jack Caffrey at JP Morgan, Nouriel Roubini, Kate Moore, and a whole lot more. This is Bloomberg.
Welcome back to another special Miami Open update for Bloomberg TV and radio from Tennis Channel. Nick Kyrgios claimed his first tour win in 896 days as he got past American Mackie McDonald. The Aussie's been sidelined by multiple injuries and was forced to retire in his recent opening round match at Indian Wells. And don't forget, you can watch all the action live daily on Tennis Channel.